Market open this Friday morning. A minute to go until the start of cash equities trading. Here are your headlines. It's Jobs Day. Traders watch for clues on how the world's biggest economy is recovering from the pandemic. Asian stocks struggle for direction after another record in the US. An historic deal. 130 countries and territories sign up to an OECD plan on corporate taxation, but hurdles remain, with next week's G20 meeting now in focus. And OPEC Plus talks break down. The UAE blocks a preliminary deal to hike output forged by Saudi Arabia and Russia. WTI trades above $75 a barrel still. Good morning, everybody. Friday morning. Let's take a look at those futures then. European equity market futures have been pointing slightly to the upside through the past hour or so, and that continues to be the case. So perhaps we see a little bit of movement. We saw movement higher in the US and in Europe yesterday. We did see some reflation trades globally getting a bit of a boost. Oil stocks were moving higher on a surge in oil prices. And interestingly, we have Brent and WTI not all that far apart, both of them over $75 a barrel, both of them, broadly speaking, hanging on to those gains of yesterday, but making some moves to the downside. Is the most marginal movement, down around 1 or 0.2% this morning, but both above $75. With that in mind, I wonder how energy stocks are doing here in London, and let's get to the start of the European trading session. The FTSE 100 up by 0.3%, the CAC 40 up by a similar amount, the Xetra DAX also similarly playing ball, up by 0.3%, as is the IBEX. So they're all of a mind, all moving in tandem, if you like, this morning. So all up by around 0.3% as we wait really for the jobs report. The Asian equity session drifted a little lower, and certainly a focus on Chinese stocks there, where we saw the Chinese equity market, the Shanghai Composite, down by nearly 2%. We saw other markets, the Chinex in China down by 3.5%. We saw the Hong Kong market down by 1.9%. Some people attributing that to what happened at the 100-year celebrations, or some of the rhetoric coming from the Communist Party anniversary there. We'll see whether that is long-lasting, that weakness we're seeing then in Chinese stocks. So European equity markets bucking that negativity, though, through the Asian session and moving to the upside. That's after the S&P 500 closed at a record high yesterday. Investors are waiting for today's release of the June jobs report in the United States. Payrolls are projected to increase by more than 700,000, according to a Bloomberg survey of economists. Joining us now is Thushka Maharaj, JP Morgan Asset Management Global Multi-Asset Strategist. Thushka, really nice to have you with me this Friday morning. So as we look ahead to the jobs report, we know the Fed prioritizes anything around employment at this point, or at least until very recently, that was very much their preoccupation. They're obviously watching what's going on with inflation as well. But what will you be watching out for then particularly? Will it be all about wages, or do you take wage clues from elsewhere?
Yeah, we'll be watching closely across the employment spectrum as well as the wage picture. But I'd say because of the slower pace of job gains in the last report, I think the main focus is that expectation that we're seeing that recovery. And I think the key things to be looking at are the states where you've had a wind down of certain benefits. What is that meaning for the return of people back into the labor market? We are pretty positive. We are expecting payroll gains to continue increasing at a very strong pace, given where we are in the cycle. But this will take time. We expect it to be playing out over the coming months rather than just one print.
And what implications? Yes, so of course you watch all of the data, not just one print. But what is your current thinking? What's your latest thinking on when the Fed starts to move then? Of course, there's the taper conversation, and then there's when we see an increase in interest rates. We're starting to hear more and more voices talking about interest rates going up, maybe the latter half of 2022 rather than early 2023. That seems to be the latest view from the IMF now giving us their thoughts. What's your expectation, Thushka?
Our expectations are largely in line with consensus for the taper, so announcement end of this year and a start of the tapering next year. I think there is uncertainty on how long it takes to get the tapering achieved and reduce and sort of stopping the expansion of balance sheet. So that's a variable that's uncertain. We don't expect rate hikes to be coming before the Fed's forecast. So if there's an area of risk, we would say it's actually later rather than earlier than what the Fed dots are signaling. And I think this links directly to our views on inflation rather than the labor market. We're pretty positive on the labor side, expecting a recovery in unemployment rates falling quite sharply towards the end of this year. But it's inflation where we have a more sanguine outlook after we've seen these base effects play out. And that for us stays the hand of the Fed in terms of hiking later than earlier.
And Thushka, in your notes, you talk about being in the US mid-cycle and other developed markets still being early cycle. Which cycles are you talking about here, and are they all lined? You know, are you talking about stock cycles? Are you talking about central banking cycles, just broadly economic cycles? Do they all tell the same story?
Yeah. So you're right. There are many cycles. We're talking about the business cycle, so the economic state of the state that we are seeing, and we do see the U.S. That was an innovation coming out of our quarterly investments conference, was that the U.S. economy is moving into the mid-cycle stage, where we are seeing an increase in wage growth, where we are moving away from the very strong growth that we had in the early cycle phase. It doesn't mean that recession risk is higher. It doesn't mean that from a business cycle perspective, we should be more concerned about the end of cycle. But what it does mean is that the ability to generate the same type of returns that we had over the last 12 months is more constrained now.
Thushka, stay with us. Thank you very much. Thushka Maharaj, JP Morgan Asset Management Global Multi-Asset Strategist. She's with us a little bit longer on this program. Just want to get to some lines coming through from the ECB President, Christine Lagarde. She's speaking. In fact, she's been talking to a publication in Provence, in France, and in that local media, giving some thoughts on inflation. And we just want to keep across that because the euro did seem to drop a little bit on some of these lines, or at least it timed with those lines. ECB's Lagarde says the recovery is getting underway, but remains fragile. We're not there yet on a sustainable recovery, so says Christine Lagarde at the ECB. So we will keep an eye on the euro there. 118.32 is where we currently trade. Coming up on this program, more competitive, more green, and more technologically advanced. That's what the UK Chancellor Rishi Sunak wants the UK to be. We hear more from my exclusive interview with the Chancellor of the Exchequer next. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public public-private partnership.
Welcome back to the European Market Open. This Friday morning, 9 minutes into the last trading session of the week, and European equity markets making modest gains to the upside, up by 0.2%. Let's take a look at some of the movers this morning, some of the stocks that we have on the move, and it's an entirely Finnish affair when it comes to M&A in the valve-making space over in Finland. That's the story that's moving things around for Valmet. We'll also show you shares of Neles, because it is Valmet that is doing the buying and Neles that is being bought, and as a result of that $2.5 billion share deal, we see the shares of Valmet moving to the downside and Neles moving up by 12%. Valmet managed to fight off competition from Sweden's Alfa Laval that also wanted to get its hands on Neles. So that's an interesting M&A one to watch. We also have in there some house builders, and in fact, we've got Bellway in there because Jefferies has upgraded Barratt and Bellway, so they're still positive on the home builders. They make the point that home builders' share prices are down about 10% over the past month, even as the housing market has remained strong. We know some of the supports for the housing market are coming to an end, but in terms of the timing of those share price moves, that's an interesting thing to think about. So that's the stocks we have on the move this morning. A little bit of the housing market and a bit of M&A to talk about. Thushka Maharaj, JP Morgan Asset Management, global multi-asset strategist, is still with us. Thanks for staying with us, Thushka. Let me ask you about M&A as a theme then. We've had this M&A story breaking around the Finnish valve market, but clearly this is a much broader theme. We've had a really strong year for M&A so far. I spoke to an M&A investment banking specialist over at UBS earlier this week who was saying, yeah, this is going to continue into the second half. I suppose when financing conditions are a little bit tighter, but they're still not tight by historic standards, you might expect M&A to continue.
Absolutely, Anna. And I think this is one of the tailwinds we foresee for equity markets in coming months. As you say, cash balances are high. It's quite an extraordinary cycle in the sense that we didn't see the damage to balance sheets that you would normally expect in a recession. Policymakers have ensured that balance sheets are resilient, and what this means is that we will have more opportunities, more scope for companies that have those strong balance sheets to engage in M&A activity. I mean, we're watching very closely the impact this has on small cap equity markets. When we think about our pro risk positioning within multi-asset solutions, part of this is getting exposure to that cyclical recovery, but also expectations that as you see the broadening out of this economic cycle, as the U.S. moves more into that mid-cycle phase, that you will see more M&A activity supporting risk.
Yes, and I know that you've changed your stance a little bit, perhaps, on credit markets since we last spoke, Thushka, and I wonder what's driving that. We've seen credit spreads, of course, are very tight, and I'm thinking about U.S. corporates, but there are other areas where we've seen actions by central banks coming in to support markets, and that's meant that we've managed to maintain, achieve, and stay with pretty tight spreads. Does something break in that, Thushka, as we start to see support from central banks pulled away or from fiscal authorities pulled away? Does anything break in that? Are we going to uncover some fairly fragile balance sheets or no?
Yeah, you're right to highlight the credit view. I would say our change in stance there is not a fundamental change. It's more a valuation case, as you highlight, with spreads where they are for U.S. high yield. I'm just looking at indices for the Barclays U.S. high yield index, below 270 basis points. The absolute yield we are earning to take on that credit exposure is a lot lower than where it was, and this just means that when we're thinking about the most efficient use of our risk budgeting, it's more in equity space. But to your question, where can things break? I'd say we were very encouraged by the price action or the reaction of the credit markets when the Fed announced that it will start very gradually reducing some of that secondary market credit facility purchases that it made during the height of the crisis. I know it was small amounts, but the fact that the market absorbed that very easily was a very, very strong signal. What we focused on in credit at the moment, at a headline level, see spreads being tight, but what we're much more focused on is this now the start of an upgrading cycle for those Class B names within high yield, and so basically focusing on that double B sector within high yield, trying to be more targeted on our exposure, essentially.
Thushka, thanks very much. Thanks for your time. Have a good weekend when we finally get there. Thushka Maharaj, JP Morgan Asset Management, Global Multi-Asset Strategist. More competitive, more green and more technologically advanced. That is how Chancellor Rishi Sunak plans to keep the City of London the premier destination for financial services in Europe. I spoke exclusively to the Chancellor on a range of topics, including financial equivalence, green bonds and a return to the office.
Europe is always going to be a close partner and ally of ours, and we're always going to be constructive in that relationship and remain available to answer any questions that they might have about that process, which we completed some time ago. But what I'm interested in doing is making sure that our financial services industry here in the UK is something that we can all and should be very proud about, because it creates jobs locally and prosperity nationally. And that's why today we published a roadmap to deliver our vision for a financial services industry that is more open, more competitive, more green, and more technologically advanced. And that's the exciting agenda that we're delivering.
Yes, and how will that roadmap stand up to the competition then, Chancellor? We saw that JP Morgan just this week opened a 6-story trading hub in Paris. The French finance minister said, thank you, Brexit, for that. London is still the biggest financial services hub in Europe, but that is being chipped away at. Does that concern you?
No, I think if you look at every survey that's being done, it still shows that the UK and London remains the premier destination for financial services. And that's because we have fantastic strengths here, but we're going to build on those strengths, not rest on our laurels. And the roadmap that we published today, I think, shows that London, the UK more generally, will be the most advanced place, the most exciting place for financial services anywhere in the world. We're going to be a leader in green finance. Just look today at the documents that we published around a green sovereign bond and a green retail bond, our plans to create a carbon offset market, just one of the many things we're doing to show leadership globally, create new markets here and new jobs.
Just finally, Chancellor, you say about going back to work. We're both here in the City of London. It's not as busy as it used to be pre-pandemic. Does it matter to you whether the city comes back physically, whether we all return to the office, or are you fine? Are you happy to see people working remotely for maybe part of the time?
Yeah, well, actually today we had a slightly different Mansion House audience, and there were lots of young leaders, the next generation of financial services leaders in the audience, and I was speaking to them after the event. And you talk to all of them, they are all super excited to get back into the office on a more full-time basis, because they enjoy the training, the collaboration, the spontaneity and the mentorship they get from being physically in the offices. And I think it's very important for young people at the start of their careers to have all those benefits. And I hope as we make progress towards our July 19th step and safely take that step, we can get the city humming back to life as we all want to see it.
UK Chancellor Rishi Sunak there speaking to me about Europe and the return to the office. Interesting, he puts the focus on young members of staff and what he thinks they would like to see from a return to the office. Let's get a Bloomberg Business Flash, some of the top corporate stories we're covering here at Bloomberg. Here's Laura.
Thanks, Anna. Johnson & Johnson says its coronavirus vaccine neutralizes the fast-spreading Delta variant. J&J found that over 8 months, recipients developed strong antibodies against all variants, including Delta, but it's still not clear when a booster shot would be needed long-term. Delta is expected to become the dominant strain in the US in the coming weeks. Robinhood is readying for IPO liftoff and warned it could turn into a meme stock with its larger than usual offering of retail shares. The trading app turned profitable last year, only to have losses surge in the first quarter to $1.44 billion. Bloomberg Intelligence said the company may be valued at around $40 billion. Robinhood signaled its breakneck expansion may not be sustainable and also revealed looming legal threats. Airlines are gearing up to boost traffic in the lucrative North Atlantic corridor that connects Europe with the US. Carriers including United, Emirates and British Airways plan to boost transatlantic seating capacity by 40% in the 8 weeks through August 23rd. One problem is that the US hasn't actually opened its door to foreign travelers, so Europeans can't vacation in New York, Miami or Chicago. That's the Bloomberg Business Flash. Anna.
Thanks very much, Laura Wright, with the increasingly complex, it seems, rules and where you can and can't go to. Now, coming up here on this program, 130 countries back an overhaul of global corporate tax, paving the way for sweeping international changes, but the plans still face multiple significant obstacles, some of them here in Europe. More on that next. This is Bloomberg.
This week, is agriculture in need of another revolution?
The big thing in agriculture is everyone's saying, well, what can we do to get farmers to voluntarily contribute to carbon sequestration?
Big ag gets a bad rep when it comes to sustainability. But with the help of new technologies, can it clean up its act?
Today, we estimate that approximately 1 in 9 people in the world experience what we would call food insecurity.
Higher prices and lower accessibility have forced millions into food poverty. Why greater supply doesn't always mean fewer empty bellies.
Everyone says, how do we fight climate change? Well, we plant trees. And so we're basically planting a rainforest under the sea.
How one of the world's fastest growing plants could provide an alternative to traditional agriculture as well as a climate solution. I'm Kaylee Lyons. Don't miss this week's edition of Bloomberg Green. Catch it on Bloomberg TV and on Quick Take this weekend.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Welcome back to the European Market Open. 22 minutes into our trading session. We have European equity markets making moves to the upside broadly. We also have some interesting moves in the euro. The euro a little bit weaker this morning, down 0.2%, continuing to drop. It dropped on some lines from Christine Lagarde. She was speaking to a local publication in the south of France. So we will get some further analysis of those moves a little bit later on in the program. Now, we've been following, of course, the G7 conversations around tax, and we're moving very quickly towards the G20 finance ministers and their meeting, which is going to take place next week. We're expecting sign-off of an agreement in principle around taxation, but obstacles still remain for a deal. Let's get more on this with Bloomberg's Maria Tadeo, who's live in Madrid. So, Maria, we saw a deal. We saw something being signed. What's the detail of the agreement, though? Because there have been many iterations, many versions of this.
Yes, Anna. And look, yesterday we had that announcement from the OECD. They say this is really nothing short of a tax revolution when you look at the 21st century economy and how to tax digital businesses in particular. Now, they say there's two pillars to this announcement. One that would entail that minimum corporate tax of at least 15%. And the second one that would allow countries to tax countries based on, or companies, I should say, based on market jurisdiction. You know, there has been a lot of criticism, particularly in Europe, that a lot of these big companies were shifting their tax imprint and their profits to low tax jurisdictions. This would allow them, according to the OECD now, to bring back about 100 billion euros in taxes that until now have not been marketed to jurisdiction. Now, as I said, this is a broad agreement of 130 countries in an organization that counts with 139 members. There are still 9 that are holding out on this, but it does seem that this is now really paving the way for a big agreement next week at the G20 in Venice.
Okay, so we'll watch that. But some of the countries that might not be at the G20, we see some holdouts, and some of those are in Europe.
Yes, and you know, the obvious one here, of course, is the Irish government. They put out a statement yesterday reacting to this, saying they would allow or could agree in principle to this reallocation of taxing and allow countries to tax in their own countries where they provide their services to these big companies, but they could not agree in principle at this stage to that at least 15% corporate minimum tax. Now, there's 2 reasons as to why this is something that is hard to swallow for the Irish. Of course, we know that they have a big competitive edge over that low taxation, but also the wording of at least 15% does open the door to take that even higher from 15. The gap between the effective rate and a potential 15% rate in other countries would also see that gap go bigger and lose that bigger competitive edge. So for the Irish economy, this could be very turbulent times.
Okay, something the Irish are focused on. You mentioned that, well, Hungary and Estonia are other holdouts here in Europe. Maria, thank you very much. We'll look ahead to the G20 meeting next week then with all of that in mind. Maria Tadeo joining us from Madrid with the latest on the global tax push, the push for global cohesion around tax and around corporate tax. Now, coming up on this program, temperatures in the Pacific Northwest are smashing records, causing hundreds of deaths. The wave is caused by a rare phenomenon known as a heat dome. We'll get you all the details of what a heat dome is, what is this doing to temperatures in North America, what is the damage being caused, what's driving it. We'll talk about that next here on the European Market Open. This is Bloomberg.
excluded from the workplace, especially when you've got skills and motivation and things to give, can have a really detrimental effect on people's well-being. They can become isolated, of course have the financial stress of not being able to support themselves. That might be their first entry into the broader community where you're building relationships with workmates, and so that's your exposure to culture and you're starting to feel like you belong.
Some people might need to practice their English more. They might just need just some practical experience in an Australian kitchen.
I have not from Australian friend now, but in the kitchen I have many friends.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the European Market Open. Half an hour into our session here in Europe and making decent gains. It's jobs day, of course. We'll wait for that. But we've got European equity markets up by around 0.5%. Some M&A in the industrial space over in Finland, certainly pushing the Neles share price a little bit higher. We heard about that a little earlier on this morning. We have Valmet beating Alfa Laval to get its hands on Neles. And so Neles, that share price up by 9.9%. Let's have a look at where things are on the sector breakdown. This is what we have for you. We've got most sectors in positive territory, actually. Only banks to the downside. Elsewhere, we push higher with reopening trades such as travel and leisure and reflation trades like basic resources or perhaps recovery trades moving a little bit higher. But broadly speaking, most things are in positive territory, at least at the sector level. Interesting to note that Nasdaq futures have turned the corner, and they were negative earlier on, now up by 0.2%. So as Europe is improving, we're seeing US futures also improving. Some interesting news lines coming out around share trading and where it takes place here in Europe. London is back on top in European stock trading as the top European stock trading hub in the month of June, says the CBOE. And this is in the context of Amsterdam having overtaken London as Europe's largest share trading centre back in January, after Brexit, of course, saw a lot of that trading have to move from London to the European continent. The city's volumes moved to the continent then, and it's taken until now, but it has happened now for London to rediscover that top spot, at least in 1 month of data. So that is interesting to look at anyway. Now, as the heat rises, the climate conversation becomes less abstract. This week, temperatures in the Pacific Northwest are smashing records, causing hundreds of deaths, raising drought fears and testing the limits of the power grid. The heat is now reaching New York City, where residents are being asked to conserve power.
As climate change induces extreme weather events more and more frequently, we need to make investments to build a more resilient grid.
Joining us now is Bloomberg Green reporter Akshat Ratti. Good to speak to you, Akshat. So how is climate change then playing a role in all of this? Because we've seen we went from a period where climate scientists maybe were a little uncertain about attributing climate change as the reason for individual weather events, but it does seem to be that climate scientists are more confident about doing that now. What's the degree of urgency that we're talking about doing something about this then?
So in the past, the reason why a single event could not be attributed to climate change was because it took a long time to do the studies to be sure that climate was playing the role there. Now that those things are speeding up, both because of the science, but also because of our ability to be able to run these models, which require a huge amount of computation, more quickly and run them in numerous ways. And so scientists are getting more certain about linking events to climate change. Now, in the case of the heat wave that we are looking at specifically, well, the extreme is so extreme that it's very hard to not be sure about climate change's role. So typically when temperature records are broken, they are broken by 1/10 of a degree. In this case, in Portland, in Canada, we've seen temperature records being broken by 10 degrees. And scientists are almost certain that climate change is one of the reasons why already an extreme weather event is becoming more extreme.
We've talked about what this is doing to populations affected, and in some cases, sadly causing death, Akshat. But a lot of businesses and ability to feed ourselves can also be affected. What impact is all this having on agriculture?
We've heard some really sad stories about almond trees have to be uprooted because there isn't enough water. Apart from the heat wave in the Northwest, it's also going through one of the worst droughts in the last 20 years. There are entire fields that are laying bare because there isn't enough water to plant strawberries or lettuce. And we're going to start seeing some of that impact show up in food inflation figures. And now this is not just the Northwest. We are seeing extreme weather events in other parts of the world. Eastern Europe, for example, has had a heat wave. Siberia and the Arctic has seen one of the worst heat waves in recent history. And so all of that will feed into agriculture as a concerning area, because agriculture is entirely dependent on the weather being predictable, and it is not in many parts of the world.
This is certainly not predictable, and maybe was not or is not very usual at all. Akshat, forecasters say then that the heat wave is supposed to last until next week. That's quite a prolonged period to have such out of the ordinary, such high temperatures. What impact is that going to have on grids, which I imagine are coming under pressure? From air conditioning use?
Mostly that is true, especially in America, where people do have the ability to afford air conditioners. The demand has shot up, and we've seen these advisories put out both in New York and in the Northwest to try and conserve power, and many people have done so, and that has helped. But in the long term, we're going to see more and more of this happening. You know, emissions are still quite high. They haven't started falling nowhere at the pace at which it needs to fall. And so one of the things that needs to be talked about at the political level now is not just cutting emissions, but also adapting and making the grid resilient. A recent estimate from a consultancy firm found that about $500 billion worth of investment will be needed in U.S. grids to make it more resilient to deal with climate events.
Akshat, thanks very much. Thanks for joining us. Akshat Ratti, our Bloomberg Green reporter here in London. We'll certainly keep an eye on those temperatures in North America. Coming up here on this programme, Credit Suisse extends its pay boost to more staff as the big banks compete to keep staff through the pandemic. We'll bring you that story next. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
What we have decided to do is be in the office Tuesday, Wednesday, Thursday, and work remotely on Mondays and Fridays. And that will be up and down, everyone from Ken Jacobs and me down to including analysts. We think this combination is the most attractive, that you get the best of both worlds. And we think this is great for people who are at Lazard and people who want to come to Lazard. So it's both a retention approach and a recruitment approach. There's a lot of competition for bankers right now.
The future of work at Citi, we'll see nearly all of us back in the office, but there's a big but with that, and that's with increased flexibility. We're looking at a much more flexible approach going forward, and I think it will be a competitive advantage for us.
Peter Orszag of Lazard there, and Citigroup Chief Executive Jane Fraser on efforts to retain staff and their approach to flexible work. Let's linger on that topic a little bit longer. Banks are doing more to retain talent as the industry competes to keep staff beyond the pandemic. Credit Suisse is boosting base salaries in wealth management by as much as 20% at the top end as it seeks to hold on to staff after a series of scandals. Bloomberg's Tom Metcalf joins me now. We've heard a little bit. Good morning to you, Tom. We've heard more about this, haven't we, through the week. What are some of the latest moves, then, that banks are telling us about? What are the latest stories?
Yeah, it was like a real spectrum, basically. So just heard Jane Fraser there, Citi kind of making a big stab at saying, hey, look, we're going to be more flexible, and we see that as sort of a competitive advantage. But then today, you just had one of Goldman's top executives saying, we see the office as the center of gravity. So kind of most banks are sort of filing between those two elements. And it's obviously a global story, so as you go across regions and across sort of different stages of the vaccination programs, it all changes.
Yes, I wanted to ask you, what are the sort of dividing lines that are emerging? Are they temporary, based on vaccine stories, or are they more permanent? Are they geographical? Are they about the individual type of job that you do? What's the story?
So a lot of the experts we say is because finance is so varied, it's kind of difficult to generalize across, let's say, an entire bank even.
Yeah.
So often what we're seeing is the traders and maybe the rainmakers are much more inclined to be in the office. But then when you have a more retail-focused bank, you're likely to see someone like HSBC or Standard Chartered being extremely flexible. So Standard Chartered, for example, have basically said, we are going completely into flexible working, hybrid models, we're going to need less office space. But those traders at their desks, they're going to stay there. That's at least what it looks like at the moment.
Yeah, it's interesting to hear Standard Chartered join the dots between this return to office plan, the hybrid model they're adopting, and what it's going to do to their real estate footprint. What about the City of London then, Tom? What are we expecting? I asked Rishi Sunak, the UK Chancellor, about this yesterday. He put the focus very much on what he sees as what younger members of staff might need. He thinks that they get a lot from the camaraderie that comes from, and the mentorship that comes from being in an office and surrounded by more senior staff. Some more senior staff might want some more flexibility. So what are we seeing in the City of London?
Yeah, it's just a very big variety. And frankly, like right now, it's a bit early to say. So the big date everyone's looking to is initially July 19th. That's when apparently, hopefully, the social restrictions will lift here. But then the question is, you're right in the summer holiday. Will it really be the City of London as we remember it? So a lot of people are sort of flagging to me that it's actually more likely Labour Day. So the start of September, you've had the summer holidays, and that's probably going to be the first big test of, what will the City of London look like going forward? I think probably the safest thing to say is it won't look like it did before, but equally it probably won't be as empty as it has been for the past, what is it now, 18 months or something?
Right, yeah, interesting. Yeah, of course we won't call it Labour Day, won't be a pivot around Labour Day here in the UK, but that's the date that you're thinking about. Tom, thank you very much. Thanks for bringing us the stories, varied as they are across the banking space. Let's keep our focus on the future of work, and British companies are finding it more difficult to fill jobs as they expand hiring following a loosening of coronavirus lockdown rules. It's a friction that may weigh on the strength of the country's economic recovery. Joining us now to discuss this and many other issues on the future of work, Peter Cheese, CEO of the Chartered Institute of Personnel and Development, the CIPD. Very good to speak to you, Peter. So let's start our conversation there, shall we? The difficulty in finding staff. We hear reports from hospitality to driving jobs that it's difficult to find the staff right now. Where is this friction coming from?
Well, it's in some senses a mismatch of supply and demand in the overall labour market, but these aren't entirely new. They've perhaps been exacerbated as we come out of the lockdowns and into an economic recovery. But hospitality is a sector that's struggled for a long time, and we've had driver shortages for a long time. We've had health and social worker shortages for a long time. But of course, the pandemic has created some different dynamics. People coming off furlough, many people shifting between sectors. That has happened during the course of the lockdown. So it's, as Tom said, many aspects of the labour market at the moment are a little bit hard to unpick. But there's no doubt the labour shortages are requiring organisations to think differently about how they recruit and how they hire and how they train.
Yes. And is the furlough is the furlough part of the problem here, Peter? As brilliant as it has been for helping the UK economy get through what's been an epic period, I did hear one restaurateur yesterday saying that perhaps the furlough was in part to blame because people were discouraged from moving jobs. Because if you fear another lockdown is coming, you fear you won't get the same protection or you're not entitled to the same protection in another role. Is that part of the issue, or is it just that post-Brexit and during the pandemic still we need to think about increasing the flow of migration into the UK?
It's sort of all of the above, isn't it? Because during furlough, indeed, many employers have said that maybe furlough is restricting people from moving between jobs. But equally, I think there'll be many people on furlough who said, you know what, maybe now is the time to move. And indeed, there've been quite a lot of recent surveys over the last days talking about how many people are considering moving job now. So, as I said, these dynamics are quite hard to unpick, but I think there's no doubt that we are seeing, as I said, a supply-demand imbalance, critical skills shortages in a number of sectors. You've been highlighting banking, but tech skills, as I said, social workers, construction and trade skills, drivers, things like that. And that does require organizations to think differently. And I think a big part of it, as you've already explored, is going to be providing that opportunity for people to be able to work flexibly. And I think that's a big learning that's come out of the pandemic.
Right. So if we're moving to a period of more flexibility, Peter, where will we see that and where won't we? And will it be about geography? Your focus, of course, is on the UK. We hear slightly different messaging coming from US banks versus more European-focused banks, but maybe it's too early to draw any big conclusions. But we do have a big divide between Europe and the US right now when it comes to holiday entitlement, vacation entitlement. That culture is different. I wonder if this will become another cultural divide that's similar. What's your expertise telling you?
It could be. I mean, I've spent a lot of time all over the world working in different countries, particularly the US, and you're right, there are some slightly different working cultures, but the dynamic of the labour market in terms of what people expect doesn't vary hugely. I mean, there have been lots of surveys over many years asking young people what they expect of their future careers, and a lot of them for years have talked about things like more work-life balance. Doesn't matter where you are, and more voice and more control over what they do. These are changes that we've needed in the world of work for quite some time. But as I said, I think there's no doubt that the pandemic is acting as a big catalyst, a big stimulus for change on these things. And flexible working is about inclusion as well. It's about opening up your talent supply lines to people who may have different needs, who can't perhaps work full time or have constraints in terms of their working hours. And the other very important point to make in all of this is, whilst we tend to talk so much about these people who've been working from home, in the UK, and I think in most economies, less than half the workforce was working from home because they still needed to be in places of work. So we've got to make sure that in creating flexible work, we think about flexible working, not just from location, but also from hours and schedules and patterns of work, so that we can create, flexible working in all these forms, much more part of the norm of working for the future.
You've talked in the past, Peter, about whether we might move, one element of that flexibility could be 4-day weeks. And I think you were not just talking about more people electing to ask for that, but about maybe moving to that as maybe a more normal assumption. I know that UK government spokespeople in the UK have pushed back and said there's no plan to do that right now. Other politicians in the past have picked up on it. What would that add to the mix?
Yeah, I mean, what you're showing here is that people do, I mean, it's a sort of feature of flexible working where people either work 4 days a week, so they're working, you know, that more part-time, as it were, or they're working compressed hours. So these are already features to some degree of the labour market and flexible working. But of course, the bigger debate about so-called 4-day working weeks is where we could really maybe in the future get to a point where, in simple terms, we're producing just as much as we are in 4 days as we would have done in 5 days. In other words, productivity has really improved. Now, you know, my view, and I think a lot of people's view, is if we really harness technology and as it advances in the ways that it is, and we work smarter and not just harder, who knows, maybe that will become possible. And I often go back to people like John Maynard Keynes, the great British economist in the 1930s, said that he thought by now we would be working 15-hour weeks. And yet the pattern of work over recent decades is for many people be increasing stress, increasing workloads, people working more hours to make ends meet, and all those sorts of things. So I think having in mind a future which might allow us to work less intensely, work smarter, would be a good thing. But the other final point I would add, which is so important in this, is if we are to work to a 4-day week, which says that we are paying people what they would have earned in 5 days, then we've got to find ways to distribute wealth that is created from more of this productivity much more evenly across all of our workforces.
And Peter, just briefly, taking it back to the very short term, we have a slightly chaotic situation at the moment. How much friction is being caused in the labour market, do you think, by COVID rules that are forcing schools to close, people to take time off work at this point, and that burden not being felt by everybody equally, I guess, within society?
No, indeed not. And working parents, it's been a struggle throughout the pandemic, you know, dealing with school-aged children, teaching and learning from home, all those sorts of things. And of course, as we've gone through this and schools have started to reopen, I know many working parents were hoping that that would be the end of some of this. But of course, with some of the rules in place at the moment, and I know they are under review, which says that if you have a child in a class who's exposed, then they've got to be isolated so they're back at home. That's created some of these difficulties. And what I would say from an employer's perspective, it's so important that employers do understand this, and that the managers, and this is a really important point about training managers more to have these kind of conversations, are aware of the constraints that people have and being able to provide some flexibility in perhaps their working hours when they might start or finish. And these dynamics won't go away entirely. And I think they're very much part of this flexible working culture.
It all meets there, doesn't it? Peter, thanks so much for giving us your time. Really interesting conversation. Peter Chi, CEO of the Chartered Institute of Personnel and Development. Coming up on this programme, US Jobs Day. Speaking of jobs, we'll discuss the expected rise and the state of the economy next. This is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European equity markets. Open 54 minutes into our trading day, and we've got European equity markets making moves to the upside. Banks are under pressure. BNP and Intesa head for investor payouts, though we understand, as the ECB argues for caution. We'll keep in mind that payout story as we look at banks. Laura Cooper, Bloomberg's Markets Live macro strategist, joins us. And of course, it is good morning, happy Friday, happy Jobs Day, Laura. It is Jobs Day. What are we expecting the market to do with this jobs data later?
Well, certainly the consensus expects a 720,000 print with a whisper number of about 800,000. But there's a wide band around that, which really raises the bar for any market reaction. But that being said, there is a risk of an upside surprise, because what we've seen is that the pace of hiring has actually lagged the rest of the strength in the economy. So there is some catch up due there. And it's crucial this time around because the Fed has signaled that it's going to be more data dependent. They're already watching for signs of sustained inflation, and they do expect a labor market recovery to be very strong. So today's print will actually be quite important.
So we'll watch that, of course. That is the data print of the week, certainly the data print of the day. Let me ask you what's going on with the euro, though, Laura, because we've seen that actually weaken quite a bit in the last hour or so. And we got these lines from Christine Lagarde at the ECB doing an interview with a southern French paper. Did that change the stance around the euro?
I think at the margin, those dovish comments from Christine Lagarde just warning that the fact that this is a recovery that's not yet showing signs of sustainability, that did kind of extend the euro weakness. But that's largely coming off the back of this broad dollar bid. So the Bloomberg, or so the ICE dollar index is back above 92.5. That's the highest it's been since about April. And so really, I would expect that potential further upside should we get a strong U.S. hiring print today.
Okay, Laura, great to have you with us this morning. Laura Cooper, Bloomberg's Markets Live macro strategist. Thank you very much for joining us. We will, of course, keep an eye on what's going on with oil prices as well. OPEC Plus will be back to try and reach a resolution of their differences, try and resolve those differences. The UAE adopting a different stance from the others yesterday and slowed things down a bit. Oil prices rose on that news, a little bit flatter to negative this morning, but both Brent and WTI over $75 a barrel. That is it for the European market open. Surveillance early edition is up next. If you are in London, enjoy today's sunshine. You won't see it again for a few days, it seems. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Technology is changing how we can get our work done and where we actually need to be to do that work.
There were lots of young leaders, the next generation of financial services leaders in the audience, and I was speaking to them after the event, and you talk to all of them, they are all super excited to get back into the office on a more full-time basis.
We're looking at a much more flexible approach going forward, and I think it will be a competitive advantage for us.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Friday, the 2nd of July. I'm Francine Lacqua here in London, and here's what's coming up on today's program. 130 countries and territories sign up to an OECD plan on corporate taxation. Hurdles remain with 3 EU countries holding out ahead of next week's G20. OPEC Plus talks break down as the UAE blocks a preliminary deal on output increases. WTI futures close above $75 a barrel for the first time in 3 years. And the North American heat wave, temperatures in Canada close in on 50 degrees Celsius with more than 300 dead from extreme heat in British Columbia. So we do have quite a lot going on. Of course, officials from 130 countries have endorsed setting a minimum tax rate for international corporations. That sets the stage for G20 finance ministers to sign off on an agreement in principle next week and a possible implementation of its rules as soon as 2023. Obstacles, of course, still remain for the deal. So let's get straight to our top market story with our Danny Berger. So, Danny, what exactly were the main takeaways? First of all, good morning and happy Friday and happy Jobs Day.
But happy Jobs Day, happy Friday.
Yeah, what were the main takeaways out of the OECD Global Tax Agreement?
Well, part of it is that this is an agreement, not a deal. But what they are saying, their aim here is basically 2 steps. One, you have that minimum tax rate, so that's at least 15%. So someone like an Ireland, for example, would have to increase their taxes. The other part of it is that companies would get taxed based on where they're operating. So you can't be a Google or a Facebook and domicile for tax purposes somewhere else where you'd get kind of a tax haven. That wouldn't be possible anymore. But as I say, this isn't an agreement. It isn't a deal yet because 130 countries are endorsing it out of 139. So you have the likes of Ireland, for example, expressing some skepticism on this deal. And Francine, there's also a question to whether this will be able to pass in the U.S. Congress as well.
Yeah, I mean, so many questions, and of course, whether some of the countries that have so far said no, if there's any way of bringing them in. We're also bracing for the unemployment figure, and I guess, Danny, because we're priced to perfection, any move on unemployment could actually change the path for stocks today.
Exactly, and it's such a tricky time for unemployment figures because there are a lot of strange seasonal type effects that we have to deal with. So far, what we do expect is a better figure. A 720,000 is the survey from Bloomberg of different economists. The whisper number, if you go to WHIS Go on your terminal, is somewhere around 800,000. But of course, that's an improvement from May. Again, the big risk here is that we get another disappointment. That would be the 3rd month in a row. And despite the fact we have some optimistic calls, be it the Bloomberg survey, there are still plenty of people who think we're going to miss. And that's kind of why we're seeing some of the market reaction that we are. We have stocks that continue to melt up, continue to hit new highs, 6th consecutive day in a row. But if you look at the long end of the bond market, Francine, that's moving lower today. People are buying the long end, perhaps some concerns about economic weakness. And you can see that here we're at 2.0491. Andy Brenner over at NatWest says that this is people punting on the long end because they do think that we're going to get a disappointing figure.
Yeah, so that's the big one to watch out for. Danny, I also have a really fun story, and I know you and I have been talking about space for quite some time.
Yeah.
Virgin Galactic now jumping 33% in pre-market trade, and this is like the fight of the billionaires.
Yeah, one-upping Jeff Bezos, going to space sooner than him. Of course, this is like the fight that billionaires have, is who goes to space first.
Yeah, I love this story. Then we'll have plenty more, of course. On space, this is one of the top stories, and actually it's like the battle of the billionaires as much as anything else. Now let's talk more about today's U.S. jobs report with our next guest. He's HSBC global economist, and he is James Pomeroy. James, what a great day to have you on. Happy Jobs Day. Do you worry that actually any kind of change to the jobs, either, I mean, mainly a disappointment in jobs, will actually change the way we view Fed?
It's difficult because I think these headline figures, everyone's going to look at them. They're the numbers everyone's going to see on their screens, the ones that the market's going to react to. But I think at the moment, you just need to take a little bit of time to digest them. You know, we need to think a little bit about, okay, say payrolls is 700,000 today, say it's 800,000. How much of that is people who are taking the jobs that are available? How many of it is jobs that are, well, people being cautious about rejoining the labor force? How much of it is that maybe you haven't had an enormous increase in the number of jobs available, maybe you have. And that these sort of stories are going to be really, really important. And also on top of that, you have to think about what is the wage bargaining power of the average person out there. And I think that's the biggest driver here. If you've got people who feel comfortable they can get a job, that they can get paid in the course of this year, then the economic recovery can stay strong. If the economic recovery stays strong, that's where you get maybe some of these inflationary pressures hang around a little bit more. Maybe that makes the Fed think a little bit more intently, maybe about policy. But you know, if you just see a sort of on a consensus print here, I don't think that's necessarily going to change too much about what the Fed's thinking.
So, James, where do you stand on this? I mean, we're certainly seeing a lot of wage pressures in terms of bankers, right? We heard it from Peter Orszag. We heard it from a number of chief executives also lifting the pay to certain junior bankers. Is this, typical of actually what's happening in the banking world, or do you think there's something more that in the recovery phase you need the right people, you want to go, you want to have that boom, and you need to make sure that you pay people to attract the right talent?
I think it's something that's going to be the case across the world. We're seeing it really clearly in the low-skilled sector, quite clearly, where people are trying to bring people back into certain industries. In higher-skilled sectors, this is something we've been thinking about in terms of the geographic mobility of labor. Now, if you think about someone who's theoretically a skilled worker, your ability to work for different companies is much greater in a remote working environment. So you've got much stronger wage bargaining power. And you could actually see certain skilled employees, their wage bargaining power is much, much higher in the coming years because of much more remote work and greater choice of employers. And that could be the case in banking or other professional services. But equally, there's going to be a lot of jobs where that wage bargaining power is much lower. And if you don't need to get into the center of New York or London or Hong Kong, well, actually, then you've got a greater pool of people to pick from. So I think you're going to see this big divergence. The people with high-skilled jobs or people who are very, very good could see their wages rise quite a lot, but maybe some of the others may not. And you could see this big distortion, I guess, between the certain types of people and certain other types of people in terms of where the wage growth is in the coming years.
James, as an economist, how do you view the global taxation deal? So we have 130 countries or institutions actually signing up. In Europe, there are 3 that are against it. Does it actually make a difference on how you model some of the recovery, or does it not really come into play?
It doesn't at the moment. I mean, it's one of those things where we know that governments across the world in the course of the coming years are going to have to raise taxes in one way, shape or form. And corporate taxes feels like a pretty sensible way to do that. And we've argued that it'll either be corporate taxes or it's going to be high income persons taxes, so on the higher income people. So it seems sensible. But at the moment, you've got to get everyone over the line. You've got to get this put into law. And until that happens, it's hard to think about the real implications of it. Again, that rate is unknown as well. But in terms of the recovery, the thing that's going to matter most is how comfortable people feel spending. And it's going to come back to those jobs figures. It's going to come back to some of the impact of how willing people feel like they can run down their savings. If people feel like they can run down their savings, feel comfortable with their employment prospects, that recovery is going to be strong. And I think this taxation story is important, but it's something that maybe affects the situation further down the line.
Great, James, thank you so much. James Pomeroy there of HSBC, and we'll also talk about, of course, the difference between Europe and what we're seeing in terms of fiscal stimulus and the US. Also, we talk about the UK. Rishi Sunak saying Britain will make the most of its freedom to set its own rules for its financial services industry. Up next, we bring you our exclusive interview with the UK Chancellor. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, more competitive, more green, and more technologically advanced. That's how the Chancellor, Rishi Sunak, plans to keep the City of London the premier destination for financial services in Europe. Bloomberg's European Market Open anchor, Anna Edwards, spoke exclusively to the Chancellor on a range of topics, including financial equivalence, the labour market, and, of course, green bonds.
Europe is always going to be a close partner and ally of ours, and we're always going to be constructive in that relationship and remain available to answer any questions that they might have about that process, which we completed some time ago. But what I'm interested in doing is making sure that our financial services industry here in the UK is something that we can all and should be very proud about, because it creates jobs locally and prosperity nationally. And that's why today we published a roadmap to deliver our vision for a financial services industry that is more open, more competitive, more green, and more technologically advanced. And that's the exciting agenda that we're delivering.
Yes, and how will that roadmap stand up to the competition then, Chancellor? We saw that JP Morgan just this week opened a 6-story trading hub in Paris. The French finance minister said, thank you, Brexit, for that. London is still the biggest financial services hub in Europe, but that is being chipped away at. Does that concern you?
No, I think if you look at every survey that's being done, it still shows that the UK and London remains the premier destination for financial services. And that's because we have fantastic strengths here, but we're going to build on those strengths, not rest on our laurels. And the roadmap that we published today, I think, shows that London, the UK more generally, will be the most advanced place, the most exciting place for financial services anywhere in the world. We're going to be a leader in green finance. Just look today at the documents that we published around a green sovereign bond and a green retail bond, our plans to create a carbon offset market, just one of the many things we're doing to show leadership globally, create new markets here and new jobs.
Well, that's the UK Chancellor Rishi Sunak speaking to Anna Edwards exclusively, saying Europe will always remain a close partner and ally. Well, still with us, James Pomeroy from HSBC. James, first of all, when you look at the inflation concerns in the UK, and then we'll get onto financial services and maybe we'll talk a bit about equivalency. But is there a danger that the UK economy actually overheats, more than Europe and elsewhere?
I think what we're likely to see in the UK is a lot of similar things that have happened in the US. I think at the moment, as economists, we're all trying to see sort of the ready reckoners of what's going to happen elsewhere. And if you take the US, you have this reopening, this pickup in prices of certain goods and services that's pushed inflation higher. And there's a good chance we see a similar thing in the UK data as well. Now, we've seen it in some goods. Furniture prices, for example, have been going through the roof. But you're likely to see a similar thing in terms of the reopening things as well. So hotels, restaurants, recreational activities, activities, that's where we could get some inflationary pressures through this year. And that sort of earlier reopening, that pickup in spending we're seeing in the UK, we think is going to be slightly stronger than in the rest of Europe. And that's mostly because of what's happening in Europe is likely to be a slower rebound in consumer spending, just because of households being a little bit more cautious than maybe UK households are.
If you look at the various regions, is there a real danger that actually Europe falls behind, also because it just doesn't have that much stimulus compared to the US, per capita?
To an extent, I mean, the difference is the nature of spending, of stimulus has been very different as well. So in the US, what you've had is this enormous amount of money that's gone into people's pockets that's being seen very, very clearly in terms of consumer spending. But then in Europe, it's much more about sort of the longer term story. It's about, can we invest in a way that helps to increase long-term potential growth? And it's going to be the Next Generation EU Fund. It's going to be that spending over the course of the next few years. And hopefully that does enough to lift Eurozone potential growth, whereas in the US, at least what's been delivered so far is much more of like a sugar rush. Now, if that gets added to by a lot of infrastructure spending, then of course the US growth story looks very, very good. So we're in this odd situation whereby, yes, relative to the US, Europe doesn't look so good, but actually it looks pretty good compared to its own history. There's a good chance that Europe comes out of this crisis with a faster potential growth rate than before it. And I don't think that's something a lot of people were expecting a year ago.
No, that's certainly true. James, going back to the UK, what kind of economy will the UK be in 4 or 5 years? Aaron Edwards spoke to the Chancellor yesterday. He wants to be more competitive. You can see that there's something done in there for financial services. Does it actually help the bottom line of growth?
Possibly. I think the UK economy, there's certain things we're very good at. We're good at services. We're good at financial services. We're very good at being sort of creative industries as well, and technology. And I think there's clearly going to be these other professional industries that the UK is going to have to try and do very, very well in. Clearly the manufacturing sector hasn't been a big part of the economy for a long, long time and faces some challenges around Brexit and some of these trade deals. And it's going to be the real story of growth in the UK is going to be about services, both domestic and exporting them. And if the investment can be made into those sectors to allow them to flourish here, if we can get education right and we can train up our workforce to work in tech sectors, then yes, there's plenty of reasons to be optimistic, but it does need the investment. I think education is going to be a big part of this. Can we get people coming out of universities trained in the right way to make the most of the, I guess you could say, opportunities that the UK can have going forwards? If you don't do that, then we can't do it, but we're going to need that investment in the right places to make it work.
James, thanks so much. James Pomeroy there, a global economist at HSBC. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The Trump Organization's longtime CFO has pleaded not guilty to fraud and theft charges. Alan Weiselberg is facing 15 charges from the Manhattan District Attorney, which alleges that he engaged in a scheme to avoid taxes. It is the first criminal case to emerge from an investigation of former President Donald Trump and his business dealings. However, neither Trump or his sons were named in those charges. Richard Branson plans to beat fellow billionaire Jeff Bezos into space. Branson will fly on the Virgin Galactic test flight on July the 11th, along with 5 others. That's just 9 days before Bezos plans a trip to space aboard a rocket made by his company, Blue Origin. He and the crew will be joined by 82-year-old Wally Funk, who was one of the first women to train for space flight, but she actually never left Earth. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Literally, the Battle of the Billionaires is maybe my favorite story of the year. Coming up, Credit Suisse extended its pay boost to wealth management bankers as the industry competes to keep staff through the pandemic. Banks are doing more to retain talent. We'll discuss the shifting work environment. This is Bloomberg.
never sleep. So stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
What we have decided to do is be in the office Tuesday, Wednesday, Thursday, and work remotely on Mondays and Fridays. And that will be up and down, everyone from Ken Jacobs and me down to including analysts. We think this combination is the most attractive. They get the best of both worlds. We think this is great for people who are at Lazard and people who want to come to Lazard. So it's both a retention approach and a recruitment approach. There's a lot of competition for bankers right now.
Peter Orzag of Lazard there on efforts to retain staff and the company's approach to flexible work. Well, joining us now to discuss all of this is Tom Metcalf. He's our UK finance reporter. And Tom, I know you've been, first of all, thank you so much for coming in. And it's so nice to also have you in the studio physically next to me. But you've been all over the story. And it seems that, the Wall Street banks are doing one thing, except for Citigroup. Here in Europe, maybe we're more flexible. Like, ultimately, what drives the decision of whether people can work from home or not?
Yeah, it's basically a question that all these executives at the top are wrestling with. I mean, of course, there's no playbook for this, so it's not like they can look at, what happened, in the 60s when this happened. So what we're really seeing is it's basically being driven by the top. So at Goldman, you've got, David Solomon coming out pretty strongly. Office is the center of gravity. We expect all our staff basically to come back at some point. And then, on the other side of things, you've got more flexibility. So you've got, both HSBC and Standard Chartered going, hey, we've got a lot of retail banking. That's probably easier to sort of run and manage from home. So we're going to be a bit more flexible on that. But basically, there's still a huge variety.
Yeah, I mean, so it depends on the job. It depends probably on where you are geographically. Is there any evidence that people want to work from home or want that flexibility, and that's how you attract top talent?
Well, that's certainly what some of the banks are saying. So Citigroup's come out and said, hey, we're going to have, at least 2 days at home, and they think that's kind of going to be a point of difference for them. They'll be sort of saying, hey, look, guys, we're not Goldman, we're not JP Morgan, why don't you come our way? But, every side has an argument. There's people saying, hey, if you're a desk jockey, you're going to, that's what the young people really want. They want that sort of office environment. So there's an advantage to be gained there. I mean, frankly, no one really knows. And a lot of the plans are kind of still quite up in the air.
Tom, do you think it'll change? So, they have a plan for like maybe 1 year, and then you'll see kind of how it happens?
Yeah, that in terms of the time frame, that's kind of interesting. What we have seen in terms of timing is, hey, look, come September or come July 19th, we want to do this. But there's not necessarily that long-term thinking yet in terms of this is what we'll do for the next 10 years. So we are seeing people exit some of their office leases. So that suggests there will be sort of more of a step away from at least the 5 days a week in the office. But yeah, it's basically an open question.
Tom, I also need to ask you about this, HSBC report. So basically, an employee wrote a report on racism at the firm, and it's for very uncomfortable reading.
Yeah, no, absolutely. There's some really shocking moments in there. It's basically a junior manager at HSBC who distributed this report internally, which we managed to get hold of a copy of. And, it really sort of lays bare, I suppose, what, I think people sort of suspect might be happening in finance, but it's still very shocking to read about it in black and white. So HSBC have launched a probe. They obviously say they've got lots more work to do, and this is a big issue for the whole industry.
And this is probably an industry-wide problem.
Yeah, absolutely. So, if you look at the UK, in terms of diversity, I think finance is still maybe only at 3-4%, and you compare that to kind of 10%, 13% in London, for example, for black people.
Tom, thank you so much. Tom Metcalf there, our UK finance team leader. Now, coming up, 75% of UK shoppers say they have bought more from the internet than before the pandemic. I'm certainly guilty of that. Up next, we speak to the chief executive of Farfetch.com. This is Bloomberg.
G7 today need to wake up and listen to the science. There isn't room for discussion on this. Scientific inevitability, and they need to act. They don't need to talk anymore. They need to just act.
Climate change has been on the agenda of the G7 since maybe 2003. So we need to see action, not just talk. And we've only got 9 years left to halve carbon emissions if we're going to stop dangerous climate change happening.
United, we'll never be defeated. All the world is possible.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
130 countries and territories sign up on the OECD plan on corporate taxation, but hurdles remain with 3 EU countries holding out ahead of next week's G20. OPEC Plus talks break down as the UAE blocks a preliminary deal on output increase while WTI futures close above $75 a barrel for the first time in 3 years. And the North American heat wave temperatures in Canada close in on 50 degrees Celsius with more than 300 dead from extreme heat in British Columbia. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now, there's quite a lot going on in the markets as well. Of course, a reminder, happy Friday and happy Jobs Day. In the U.S., Robinhood has also filed for an initial public offering. Now, the broker disclosed it became profitable last year, only to have its losses skyrocket in the first quarter amid the so-called meme stock frenzy. Regardless, the company could actually hit a valuation of as high as $40 billion. Well, let's get more on this with our Danny Berger. Hi, Danny. So what exactly did we learn about the business model of Robinhood and their IPO filing?
Well, they are profitable, as you say, and that's, of course, a really important thing for these tech companies coming to the market. But those losses in the first quarter were really fascinating and do highlight some of the risks with a Robinhood IPO. And that is some of these issues around funding, around the meme stock revolution that Robinhood is squarely in the middle of. So that loss in the first quarter of $1 billion rather is more than double what they saw a year prior. Now, their profits also skyrocketed during the first quarter because of all that trading, but the cost really outweighing that just because of the fundraising they had to do to keep up with all of the turbulence that was going on. Francine, the other thing that really caught my eye was how important crypto has become to Robinhood. In the first quarter, 17% of their revenue came from crypto trading. This is a pretty sizable increase from the year prior. And of that 17%, a third of it came from Dogecoin. I mean, it wouldn't be a Robinhood filing if it didn't mention Dogecoin, I think.
Yeah, absolutely, Danny. And the other story, I mean, that would, you are spot on for that. The other story, Danny, that really caught my attention is that, it's not really a battle unless you have 2 billionaires trying to get into space, 3 days before each other. I mean, what is going on with Virgin Galactic? I know that pre-market, it kind of soared.
Yeah. I mean, look, we're up 26% here. Virgin Galactic doing another test flight. And this time they're going to have Richard Branson on the flight. They've done 4 so far that are crewed. But it's kind of funny because in response to Bloomberg, I mean, obviously this is the big question. Okay, you're possibly going out on July 11th. Jeff Bezos is supposed to fly into space July 20th. That seems awfully close, but Virgin Galactic's response was, look, we fly when we're ready. This has nothing to do with an arms race. But of course, it's really difficult not to view it in that way. But look, this has been a long-time goal of Richard Branson founding the company in 2004. So, I mean, that's part of the reason why we're seeing excitement in the markets. Interesting to see, I mean, will Blue Origin speed up their timeline? Probably not, but I kind of want to see a full-on battle to which billionaire makes it to space first.
I know, it's just such a good story. It's too good a story to leave alone. Danny, thank you so much. Our Danny Berger there with the very latest on the space race amongst billionaires. As a caveat. Now, the world of online shopping was one of the not-so-surprising winners from COVID lockdowns. Over the past year, more than 75% of UK shoppers say they've bought more from the internet. Guilty as charged. As lockdown measures gradually come to an end across Europe and America, will some of those consumers turn back to high street retail? We're joining us now is José Neves. He is the chief executive of Farfetch. Farfetch is, of course, a British-Portuguese luxury online retail platform listed in the US. It sells products from more than 1,300 brands, and in the past year, it has partnered with Alibaba and Richemont to increase its exposure in China. So thank you so much, José, for joining us today, and congratulations on what you've done so far. I was looking at your share price, and actually not a bad run since you've IPO'd at all in 2019. José, when you look at the, what COVID means, so about 20% of online of physical stores are still closed, but what have you seen in terms of trends of where people buy, what people shop, customer loyalty over the last 14 months? What's been more surprising for you in the space of e-luxury commerce?
I think it's been an absolutely unprecedented year for the world in every single sector. And in our case, it was very uncertain in the beginning because luxury fashion being a discretionary part of consumption, many people thought it would suffer a lot, and also being heavily weighted towards physical retail. So in luxury, in 2019, only 12% of sales were online, so very underpenetrated online. People were really wondering, including ourselves, how was this all going to pan out? And for us, it was very clear that we had to focus on our mission and actually try to find a mission within a mission. What was our mission during COVID? And we couldn't save lives. We're not, we're in the business of fashion, which is a part of human culture, very, very far from the immediate needs that the world was facing that day. But we figured out that we could maybe save businesses. And we have 3,500 designers that we sell on our platform. Some of them are the super brands of this industry, but the vast majority, they're very small businesses. They're family-owned businesses. In fact, the whole industry is family-owned. Even the largest businesses in luxury are family-owned. But these small businesses, in the case of the boutiques that use our platform, sometimes multi-generational businesses, some of them 100 years old, were probably not going to survive the pandemic. They were already facing some difficulties before. And so that was our mission. And we launched #SupportBoutiques, which was a big push to support boutiques and small designers in April 2020. And that's really resonated with consumers, and that's resulted in fast growth for our sellers and obviously for our business. We can only sell as a platform what our sellers sell. So we were very and continue to be very galvanized with that. And I think what happened overall in the sector was a paradigm shift where consumers discovered shopping high-end fashion online. And brands realized that digital had to be fast-tracked to the top of their agenda. So we're definitely not at the end of it. So we're just seeing how it all develops.
José, so talk to me a little bit about what kind of products people are buying. I probably bought, things that I don't know where I'm expecting them to wear because we're all much more now relaxed and kind of have leisure wear. But is there still an appetite for things to go out? Has the product that you're selling, you have a great snapshot of what people want to buy now and what they want to buy later. Have tastes actually changed regionally?
Yes, certainly. I think one of the big learnings is that fashion is part of culture as much as film as much as music, as much as art. And if you're engaged in this part of human culture, which I always contend that everyone is, even when they think they're not, but if you love the category, if you love fashion, you are going to engage, whether you're in lockdown or not. Now, the things you're going to buy are going to be different. So we saw, obviously, athleisure, going up, things that are easier to wear, things that are Zoom friendly, so tops and maybe jewelry and things like that are definitely more in demand and have been more in demand than things like stilettos or cocktail dresses. So certain categories and certain brands that are heavy on those categories suffered more, and others actually had a big boost. But overall, it was very, very healthy.
And how quickly do you see a shift back into the stores? How quickly or slowly, actually? Do you expect people to go back in stores, or will this change forever, that we shop online a lot more, especially for luxury?
Look, I think, online sales were 12% in 2019. They're now 23%, so kind of double the share, but that's not at a normalized basis because many of the stores are still closed. But what we know is that all analysts point to around 35 to 40% in the long term in terms of online sales. So what we've seen is simply an acceleration of what is going to be a multi-year online growth above the growth of the market. So in that sense, people are not going to go back to stores, but on another sense, there's still 75% of sales today happening in physical stores. And even in 5 years' time, when we have that 60% of sales are going to happen in physical stores. And in fact, we're big believers of physical stores. We just launched in London the new iteration of Browns, a 50-year-old boutique we acquired 5 years ago. And we want it to be this beacon of luxury new retail, this beautiful fusion of great interior design, great fashion, even a great restaurant and the courtyard, but with technology, all infused and with the technology and digitally enabled journey. And we do that. We've been doing that for 6 years. We've done a fantastic partnership with Chanel, which we keep rolling out to more Chanel boutiques to really revolutionize the digital experience in store. That, for me, is the big frontier. That is the big frontier. We know that online is going to grow. We are obviously in that field and leading, we believe leading in that field. But we also want to help brands digitize the physical retail experience so that they can treat every single customer as a VIP.
Jose, I also want to ask you, and that's a really interesting trend, I also want to ask you a little bit about what you're doing in China. So how's demand in China? I know you have a GV actually with Alibaba. Is that going to plan? Again, is luxury, shopping really increasing in that part of the world?
It's fantastic, I think, what the opportunity we have in China. China is right now 1/3 of the luxury industry, and it will be 50%, half of the luxury industry in the next 5 to 7 years. Most of Chinese luxury shopping used to be done while traveling. In 2019, that was 70%, 70. And that, as you can imagine, was entirely repatriated to China. So it's a tremendous opportunity that we have through a digital channel to be a gateway to China for all the brands that participate on our marketplace and that utilize our platform also to run their .cn, to run their WeChat mini program. So we have a full gateway for any brand in this industry to really access those customers. And now with Alibaba, we have an augmented opportunity since we have that window into Tmall. Tmall has 810 million active shoppers. We think 20 million to 30 million of them engaged in luxury. And we're bringing 95% of the brands that we brought to Tmall did not have a presence on Tmall and did not have a presence in China, period. So it is very, very exciting what this opens to the industry, both in terms of the Farfetch China app, the WeChat mini programs that we've been running for 80 luxury brands, plus obviously our marketplace with 3,500 brands. And now an extraordinary relationship with Alibaba, which we're ecstatic about, and which is really opening this new channel in one go without the brands having to do any effort to 800 million consumers. So that's very, very exciting. But obviously, we're just in the beginning of what is going to be a very, very long journey.
José, thank you so much for coming on TV today. José Neves, founder and chief executive officer there at Farfetch, and I hope we can make this a regular occurrence to catch up on what you're doing and the luxury space. Now, coming up, delayed again, the OPEC Plus oil deal hangs in the balance as a key member rebels. We discuss all things oil next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Johnson & Johnson says its coronavirus vaccine neutralizes the fast-spreading Delta variant. J&J found that over 8 months, people given the vaccine developed strong antibodies against all variants, including Delta. But it's still not clear when a booster vaccine would be needed long-term. Delta is expected to become the dominant strain in the US in the coming weeks. Now, airlines are gearing up to boost traffic in the lucrative North Atlantic corridor that connects Europe with the US. Carriers including United, Emirates and British Airways plan to boost transatlantic seating capacity by 40% in the 8 weeks through to August the 23rd. One problem is that the US has not opened its door to foreign travelers, so Europeans cannot vacation in New York, Miami or Chicago. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, OPEC Plus talks have broken down. The UAE is blocking a preliminary deal that Saudi Arabia forged with Russia on hiking output. The meeting has been delayed until later today to resolve the dispute. Now, the unexpected turn of events leaves consumers unsure whether the 400,000 barrel a day increase for August through December will come to pass. Well, joining us now for more is Will Kennedy, our managing editor for EMEA for energy and commodities. Well, I mean, first of all, I was really taken by surprise because I kind of thought it was almost a done deal. They delayed to try to get an agreement, and then boom, the UAE says actually not so. Is there a chance that that they walk away without changing anything? So going back to the agreement they previously had.
Yes, it was a bit of a surprise, and it did throw a spanner into what had been a relatively smooth meeting yesterday, where it did seem like that this compromise had been agreed, where OPEC would raise production meaningfully by the end of the year, but Saudi Arabia would get what it wanted because the whole agreement would stretch through more of 2022. In a sense, that's what threw a spanner at the works, because the UAE then said, well, if we're going to keep going with this deal, we want it renegotiated. The UAE has often thought that this deal was unfair to them in that the number it signed up to last year forces it to give up a greater share of its spare capacity to produce oil for some other countries. So it's holding firm, and the UAE is insisting that they want this changed if they're going to go with a deal. So it's a significant impasse. It's going to have to be resolved outside the meeting, probably at a higher level than the oil ministers, at a sort of heads of government level. And those negotiations are happening at the moment. We don't know how they're going, but it may take time. So at the moment, we're scheduled to talk again this afternoon, but I wouldn't be wholly surprised if that got pushed back further.
Will, so what kind of price level can we see? So if we don't have anything in the next 2 days, could we actually see oil, above 80 and beyond?
I mean, it's a very difficult one to read because there are risks in both directions. So in theory, if there's no deal today, the existing deal holds in place, which keeps production at current levels until early next year. Now, that would, of course, as you say, be extremely bullish. The market, we can see both in the flat price and the way that near oil's priced against further oil, is screaming for more barrels. And if it doesn't get them, I think we would see a significant price action. But as you can see, the market's not making that move yet. And I think that's because there's another risk, which is that the deal breaks down entirely. And then we're getting in a situation where people might start raising production again outside the framework of an OPEC agreement. So there are risks in both directions. And I think the market's going to take a very cautious approach until they see which way this impasse breaks.
Well, thanks so much. Will Kennedy there, managing editor for EMEA for energy and commodities. Now, coming up, temperatures in the Pacific Northwest are smashing records, causing hundreds of deaths. The wave is caused by a rare phenomenon known as heat dome. We'll have the details next. This is Bloomberg.
Good morning, traders. How are you doing today? Are you ready to trade? I'm going to buy Bitcoin and I want to place an order to buy Bitcoin at 33,342. So if you're looking to buy Bitcoin, if you're following our trades and if you want to copy this trade, please do. Okay, 33,342, just right here.
Economics, finance,
and as soon as it will get filled, I will
now, as a
guide you through. I'll let you know what's going to happen next. I don't know how long we're going to hold this position, but I know for sure that we will close trade in profit. Why? Because we don't invest like investors. We trade, we traders, we're day traders. And if something will go wrong, I know exactly what to do. If you want to find out how to arbitrage, how to buy several different pairs, how to buy in different directions, you can register for our webinar that I'm going to have on 17th of July. Or you can buy strategy, practice for a couple of weeks, follow our trades, and you will start trading different pairs, not only pairs that you can see on our screen. Okay, guys? I'll speak to you later.
Typically, when climate scientists look at events like these, they run what are models. They'll run a model which says the planet hasn't warmed. What would temperature events like these look like? And then they'll warm the temperature on a computer model and see what event would look like. And in the past, that process used to take months. But now, because of improvements in science and computation, scientists are becoming much more quick at doing this. And we are almost certain that climate change was responsible for making the extreme weather event in the Pacific Northwest even more extreme.
So Akshat, forecasters say that this heat wave is supposed to last until next week. What effect will this actually have overall?
So we know that the heat wave, of course, there have been deaths that have been reported because heat waves are in a way a silent killer. Unlike tornadoes or wildfires, people in heat waves actually die in their own homes because they're not able to cope with the weather. There are, of course, other impacts on businesses. So the Pacific Northwest is also going through its most severe drought in the last 20 years. And that's meant almond farmers have ripped out trees. Their entire fields laying fallow, which could have had strawberries or lettuce growing there. And that's going to have some impact on food inflation figures in the coming months.
Akshat, thank you so much. Akshat Rati there, our Bloomberg Green reporter in London, of course, following this very, very closely. Now, we're also just getting some breaking news in terms of some of the banks. We had a great roundup by our Tom Metcalf actually running us through what banks decided to keep their staff at home, which ones really want everyone back in the office 5 days a week. BNP Paribas, in the last couple of minutes, saying that they will allow some bankers to work from home for half of the time. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin, Kaylee Lyons in New York. We'll also talk about the Boston Pops, because don't forget to tune in to the Boston Pops July 4th Spectacular this Sunday. It's going to be a big one.
Okay, guys, great. As you can see, we bought Bitcoin. If you manage to buy, well done. So stay with me. I will guide you through until the end of this trade. I will let you know when to place stop on profit. With Bitcoin, we make profit based on percentage. So 0.1%, 0.2% gives us 100 pounds or 200 pounds profit, respectively. 1% will give us 1,000 pounds in profit. Okay, guys. Stay safe. Well done, all of you guys who managed to buy. As you can see, it moved up. I do not expect to sell it in 5-10 minutes. Maybe it will go down and you will have a chance to buy if you didn't have a chance to buy right now. It all depends on the brokers. If you trade through OTC, what price they will offer you. So I understand, and we're professional traders. We're not retail traders, so we have prices close to each other, buy and sell price. So sell and buy orders are closer closer than probably retail traders will get. Okay, guys, I'll speak to you later. Good, we're in, and stay safe.
Freedom delayed 4 more weeks. That's the delay expected to be added to the lifting of all lockdown restrictions in the UK. It had been due to happen on June 21st, but UK Prime Minister Boris Johnson to address the nation later today and to push that date into July. It's all down to a surge in the Delta variant, and government ministers thought to want more people to have their second COVID vaccine before they ease all restrictions. How are markets responding? Well, they're largely taking it in their stride. The FTSE 100 actually gaining ground. Strategists saying that delay largely priced in, that we could see further weakness for travel and leisure and hospitality stocks. The pound falling against the dollar, though Nomura saying this weakness likely to be temporary. In fact, money markets largely bullish on sterling, given the pace at which economic gloom has been lifting here in the UK. Indeed, last week's GDP figures pointed to an economy that is recovering quickly, and later this week we'll get unemployment, inflation and retail sales data that should all further illuminate the economic recovery.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Technology is changing how we can get our work done and where we actually need to be to do that work.
There were lots of young leaders, the next generation of financial services leaders in the audience, and I was speaking to them after the event, and you talk to all of them, they are all super excited to get back into the office on a more full-time basis.
We're looking at a much more flexible approach going forward, and I think it will be a competitive advantage for us.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Keely Lines.
It's 10 a.m. here in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Friday, July the 2nd. Our top stories today. Something doesn't add up. While there are a record number of job vacancies in the U.S., so why aren't payrolls rising faster? We'll know more after today's jobs report. Deal or no deal, a key member of the OPEC Plus coalition blocks an agreement on output at the last minute. Oil producers are trying to get the talks back on track. And a one-shot wonder, well, Johnson & Johnson says its single-shot coronavirus vaccine neutralizes the fast-spreading Delta variant. So there is quite a lot of news going on, but Kelly, there's only one to kind of tie all the markets together. And there's concern out there that we have jobs, but also because we have the July the 4th holiday coming up, if we have a disappointment or if we have a surprise to the upside, it could move the markets quite significantly.
Yeah, there could be a lot of volatility today, Francine, especially in the bond market, which does have a shortened trading day today because of the holiday closing at 2 p.m. So there could be a lot of movement before that hour. As for what happened in the Asian session, there were some positive benchmarks, including the Nikkei in Japan, but the big drags were in China and Hong Kong. The CSI 300 actually ending the day lower by more than 2.8%, the biggest decline since all the way back in early March. And that, of course, is as investors maybe rush to sell some shares after that 100th anniversary celebration of the Communist Party, and foreign investors selling Hong Kong shares as well. The Hang Seng was down 1.8%. Of course, permeating the Asian markets also is concern about the Delta Delta variant. That has shown up in FX in a big way, including in the Thai baht, which is weaker against the dollar by 0.4%. And I did want to note the Japanese yen because I know Matt Miller has been paying attention to it. It is gaining a bit of strength back against the dollar today, but at 111.47, it is still just off of its weakest levels since February of last year. As for what the picture looks like here in the U.S., Matt, I will let you speak in just a moment, but let me run you through the U.S. first. Of course, we did have 6 consecutive up days as of yesterday, the longest winning streak since February, and we maybe will add to that record high today. We're up just 0.5 point on S&P E-minis. The jobs number may, of course, change that trajectory a bit. In the bond market, steady as she goes ahead of that print, but as I said, there could be a lot of volatility off the number. Right now, the 10-year yield at 1.45%. The dollar stronger for a 5th day, and of course, the other news we're following, there is no OPEC plus deal yet. The UAE may be holding things up, so that meeting was delayed. As the market waits for some clues, crude is essentially flat, but WTI holding above $75 a barrel, Matt. Now it's your turn.
All right. Well, that's even more interesting than the yen, to be honest. I mean, we're going to focus in on that, but the fact that we don't have an OPEC decision in a market like this is really interesting. Take a look at what's going on here in Europe. In terms of moves in the benchmark indexes, we don't have a lot. It's not unidirectional. So you see the Iberian Peninsula is down. You see gains in the UK and Germany, but they're not huge. I wanted to try something a little different. When I show you my board right now, I'm going to show you some of the industry groups in the Stocks 600 to show you what's gaining and what's losing. I think it's really interesting because most are gaining, but it's the metals and mining companies that are showing the strongest gains. You can see basic resources up 1%, as well as travel and leisure. So even with the renewed concern about Delta, the spread of the Delta variant, we still have travel and leisure stocks doing really well here in Europe. On the downside are the banks. They're one of the biggest losers. There are only 3 or 4 industry groups that are down. So, but you can see in the markets where they're really heavily weighted that they're dragging on those markets. Here's the Bund yield. We can see it down along with all of the other government bond yields. And I think, you know, I've been watching the U.S. 10-year yield so closely. I can't show it because that's Kaylee's market check, obviously. But for me, Fran, I mean, it's pretty amazing to see it compressed to 144. And if you get a beat on the non-farm payrolls number, does it spring up, is my question.
I've never seen Matt Miller so animated. I mean, this is fantastic. And we haven't even talked about space yet, Matt. So once we talk about space and the Battle of the Billionaires, then we're really going to be animated. I mean, it's just such a great story. And I think Virgin Galactic, I know Kaylee has it coming up, but it was up some 33% pre-market. Now look at what else is coming up today. The German Chancellor Angela Merkel is in talks, is in the UK rather, for talks with the Prime Minister Boris Johnson on travel restrictions. Also, the ECB President Christine Lagarde speaking in an Aix-en-Provence on lessons learned from the pandemic. And then the big event, the US June jobs report, that's released at 8:30 a.m. New York time. So let's get more, of course, on what we're expecting out of the jobs data with Bloomberg's Danny Berger. Danny, it's always a big one, but this one will be really closely watched.
Exactly, because there is the potential for this to be the 3rd month in a row that we get a disappointing figure. And the risks,
third time's a charm.
Unfortunately, 3rd time is a charm. But Matt, the risks do seem to be weighing to the downside at this moment. So maybe we won't get that good result. For one, the Bloomberg survey of economists have us just over 700,000 in terms of jobs added. But the whisper number, if you type WHIS go on your terminal, is about 800,000. So the street is optimistic, but the concern here is that they're overly optimistic. Tom Porcelli over at RBC Capital Markets, always kind of the sobering view on the economy is what he gives. And he thinks that it will disappoint. For one, we had those continuing claims yesterday and they've barely budged, which bodes pretty poorly. But he also says that we expect another below consensus number, partially because of seasonality issues. We're still coping with base effects, some of the oddities of this market that we haven't quite figured out. And he says that, look, our stance on this economy at this moment in time, it's really moving, even if that below consensus call is right. So he says, as a result, they'd be inclined to fade the weakness from here, Matt.
All right, well, it's a scientifically proven fact that bad things happen in threes. So I'm a little bit worried now as well. Danny Berger, thanks very much. For those viewers who take me too seriously, it is not scientifically proven that bad things happen in three. Meanwhile, OPEC talks have broken down after the UAE blocked a deal at the last minute. A postponed decision is expected today, but we're all kind of waiting on tenterhooks here. Will Kennedy, Bloomberg executive editor for energy and commodities, joins us now. I saw one quote, Will, that said it would be like Pandora's box, opening Pandora's box to allow the UAE to move its baseline. So what are they going to do?
Yeah, I think that's a very good way of putting it, actually. The UAE is insisting that the deal is unfair to them, that it constrains them more than it constrains other parties. But as you say, these things are incredibly delicate in OPEC. You change it for one and everyone else starts screaming, what about me? So everyone's going to be very, very reluctant to do what the UAE wants, which would allow them to raise production by a huge amount. But the UAE is saying we want this and we won't agree to the deal that was on the table yesterday until it happens. So it is a real impasse. And I think that ultimately this will probably have to be settled at a level above the oil ministers as sort of heads of government level. And those conversations are probably happening at the moment. As it stands, we're due to reconvene at 3 o'clock in Vienna, but we need the diplomacy to happen before that can happen. So I wouldn't be entirely surprised if this drags out an even longer and that those talks get pushed back. At the end of the day, OPEC tries to find a compromise, and it normally does, but there are risks here that the whole thing could perhaps fall apart.
Well, we will await news maybe coming later today. Thank you so much to Bloomberg's Will Kennedy. And on to the virus now. Johnson & Johnson says its coronavirus vaccine neutralizes the fast-spreading Delta variant and provides durable protection against infection. Of course, this is a one-shot vaccine, different than the mRNA vaccines of Moderna and Pfizer. Joining us now is Eric Fanner, Bloomberg team leader of European Consumer News. Eric, it's great that if you're vaccinated, it protects you, but there are still a large number of people who aren't vaccinated, and therefore the Delta variant still is of grave concern to many people in the world.
Yes, that's right. The Delta variant is obviously spreading fast, in Europe and parts of the U.S., of course. So it is a concern. This is good news, though, that the J&J vaccine, like the Moderna one earlier this week, does neutralize that variant as well as the other ones that we've seen so far. So, it's especially good news because this is a one-shot vaccine, as you mentioned. So, it makes it a bit easier to get it to some of those people who, maybe have been reluctant or harder to find to vaccinate. You don't need to get them to come for a return visit. So it's, another piece of the puzzle that helps us neutralize this variant.
Indeed it is. Bloomberg's Eric Fanner, thank you so much. And I do want to take a quick check now on some stocks moving in free market trading. J&J is fractionally higher, but another COVID vaccine maker is not so lucky. CureVac, of course, released results from its final study of its own COVID-19 vaccine trial earlier on this week. The stock fell 8% yesterday on that 48% efficacy rate. Those losses continue. The stock down 3.4% in early hours today. Another stock that I wanted to point out is a newly public company, made its debut yesterday, or returning to the public markets, I should say, Krispy Kreme, the donut company. It IPO'd at $17 a share, closed out the day at $21, a gain of around 20%. Today, though, giving back some of that, down about 3%. And of course, I saved the best for last. We got to talk about space because Richard Branson is heading up there on July 11th, 9 days from now. He's going to beat Jeff Bezos to the punch. It is a battle of the billionaires. Right now, Richard Branson seems to be winning, as do shareholders of Virgin Galactic, because that stock is absolutely soaring, up 27% before the bell, Francine.
Yeah, I wonder whether Jeff Bezos then says, no, I want to go first. I'm going to do it 2 days before Branson. I mean, it's just an amazing story. Also, I have a prediction. Krispy Kreme will touch $25 when Kaylee tries her first donut. Although Matt and I probably have enough donuts for all of us.
You've never had a Krispy Kreme?
I have not. And that was kind of a closely held secret, and I was outed publicly on live television to the Krispy Kreme CEO yesterday. He told me I have to try the classic
This is why
glazed
I'm
one.
mentioning it.
They are the best donuts in, well, I'm not going to editorialize here. But they're
We
very
like
good.
donuts, full stop. Matt and I are fully behind any kind of donut. There you go.
Maybe I'll join you
we'll
one day.
We'll, in the break, try and convince Kaylee to maybe try a tiny piece of any donut. Coming up next, Ed Clissold, Ned Davies' chief U.S. strategist. Then later this hour, Barry Ritholtz, Bloomberg opinion columnist and Ritholtz Wealth Management founder. But don't miss Matt Miller, also all over this, the Boston Pops July 4th Spectacular. It's this Sunday. It will be streamed live across Bloomberg TV, the Bloomberg Terminal, and Bloomberg Radio. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacqua in London and Kaylee Lines in New York. Now, I want to welcome our listeners on London DAB Digital, as I do every day at this hour. The reason is because I show a chart. Obviously, radio listeners can't see it, so I will walk them through it. This one is called Reflation Nation, and frankly, I think the title is almost enough. But what it shows is the white line is the important one of the spaghetti of lines here. That's the MSCI USA, and it's the value to growth ratio. So as the line goes lower, that means the rotation is further along in terms of into growth from value. And the US is much further along than Europe, Asia, or Japan, as you can see, those of you watching from this chart, those of you listening, I'm just telling you, so take my word for it. Joining us now is Ed Clissold, Chief U.S. Strategist at Ned Davis Research. Ed, I wonder what you think of this rotation and if it has legs or if it has nails, I guess. Is it sticky? Are we going to see growth finally overtake value and hold?
Yeah, I think there's probably another leg to the value rotation for a few more months. Now, it may look a little bit different for the better part of the last year as values outperformed. It's been about the cyclical value sectors. So you got industrials, materials, energy, and financials. But there's a whole other group, defensive value, utilities, staples, real estate. And so if the market has a little bit of a more difficult second half of the year, those defensive value sectors may outperform. So you could get a little bit more of value strength before the full rotation into growth. Now, long term, we do like growth because we think the potential GDP growth for the U.S. economy is still going to be in that 2 to 2.5% range. And that slow but positive growth rate is really what these mega cap growth stocks love to see. And so that's the long-term perspective for growth versus value. But we think value has a little bit more room to go here.
Ed, what does a potential payroll surprise actually mean for stock market in the U.S.?
Well, I think the biggest thing we're looking at is actually the participation rate. If that goes up, showing that the nearly 7 million people who have been out of the labor market are starting to come back in, I think that is a sign that there's a lot more of a reopening still to go, and that would actually favor value stocks a little bit more as well. And it also implies that the Fed may have to think about tapering maybe a little bit sooner, although we still think they're going to aim for the beginning of next year. That's a nice round number, but it could pull the Fed a little bit forward if the payroll numbers are stronger than expected.
And of course, something else the Fed has to consider is the trajectory of the virus and, of course, the spreading of the Delta variant. And I want to draw a line here between kind of the value trade and just the reopening trade, because one of your colleagues over at Ned Davis has started to turn against the travel stocks. Can you just walk us through that thesis?
Sure. Yeah, Pat Chosik, who's a colleague you mentioned, has been really on the travel stocks, and there's been a great correlation between case count and the reopening trade. And so, even though most people think the Delta variant isn't going to be a major problem, but if you do get even a small uptick in cases, then things like the travel stocks tend to underperform, and so that correlation is still there. And so that may be news for the next several weeks. As we would expect, certain parts of the country that haven't gotten as many people vaccinated could see, an uptick in cases due to the Delta variant that would lead to some of the reopening trade stocks not working. And so that correlation, even though so many people have gotten vaccinated and the pandemic seems to be getting so much better in the U.S., the correlation in terms of relative performance is still there.
How does the labor shortage affect your market view? Gary Schilling has a great Bloomberg opinion piece out pointing out that a lot of industries, especially the travel and leisure industry, have been able to do so much with productivity without hiring too many additional workers.
Well, I think that's great news. I think what we've done is we've brought forward a lot of the changes that would have happened over, say, 5 to 10 years. Companies have been forced to do those over 1 year, but there's a limit to that. And at some point, we're going to need to see more hiring, and I think it does impact the potential growth rate for the economy. If we're going to lose 5-7 million people from the labor force permanently, that's going to have negative consequences. And so we do want to see those people come back into the labor force. And I do think companies are going to find a way to make those people productive once they're comfortable coming back in. So eventually, I think a lot of those people are going to come back into the market. If they don't, then you're going to be talking about higher inflation probably, because there's going to be a fight for workers, and the best way to get people to come work for you is to pay them more. And so that's gonna be problematic if too many people decide to permanently leave the labor force.
Ed, thank you so much. Ed Clissold, their chief U.S. strategist at Ned Davies Research. Now, coming up, the Aix-en-Provence Economic Conference kicks off today in the south of France. We can always dream of the beautiful cicadas playing. We'll be speaking with the Société Générale chairman, Lorenzo Binismaghi, the French industry minister, as well as the Michelin and Euronext executives. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between governments and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Jobs Day on Bloomberg Television. May's jobs report fell short.
I'm going to call it a modest disappointment 2 months in a row.
Will this month's hit the mark? The June jobs report, Friday morning on Bloomberg Television and Radio.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines in New York with Francine Lacqua in London and Matt Miller in Berlin. Now let's get the first word news. And the Biden administration and its allies are closing in on their goal of a more balanced international corporate tax system. 130 countries and jurisdictions now back a plan to set a minimum corporate tax rate. But it could be tricky getting the deal approved by Congress and the European Union. The U.S. government is sending out response teams to try to fight the spread of the highly contagious Delta coronavirus variant. They're heading to unvaccinated pockets of the country. Health officials will increase testing, provide drugs, and deploy federal personnel where needed. 1,000 counties have vaccination rates of less than 30%. Airlines are gearing up to boost traffic in the lucrative North Atlantic corridor that connects Europe with the U.S. Carriers including United, Emirates, and British Airways plan to boost transatlantic seating capacity by 40% in the 8 weeks through August 23rd. One problem is that the U.S. has not opened its doors to foreign travelers, so Europeans can't vacation in New York, Miami, or Los Angeles. And Richard Branson plans to beat fellow billionaire Jeff Bezos into space. Branson will fly on a Virgin Galactic test flight on July 11th, along with 5 others. That's just 9 days before Bezos plans his own trip to space aboard a rocket made by his company, Blue Origin. He and the crew will be joined by 82-year-old Wally Funk. She was one of the first women to train for a space flight, but never actually left Earth. So I am super happy for her, Matt. I feel a little bit bad for Jeff Bezos because Richard Branson is beating him to the punch here, though.
I'm not sure how much they care about who gets there first. For me, the interesting thing is who gets furthest away from Earth. If you're just going to go suborbital and you're not even going to get out, does it really count? I don't feel like that really counts.
Yeah. I mean, look, it's a story of the week, if not of the month, if not of the year, because there is probably some kind of, billionaire battle about who gets there first, and then there's going to be a lot of metrics about, how far you can go. And I mean,
But they're just getting to the Kármán line, right? They're not. It's not like they're going to the moon. They're not racing to Mars. They're just racing up a little bit higher than you go in a plane.
I will say, Matt, my dad is on the same page as you. He was a naval aviator, and he says, I've flown an F-14 that high. It's about 55 miles above the Earth. He says it's just very dark, but you can see the curvature of the Earth. So I guess that's cool.
And then Virgin Galactic pre-market soaring some 34%. Coming up next, Barry Ritholtz, Bloomberg opinion columnist and Ritholtz Wealth Management founder. This is Bloomberg.
morning was a bit of a historic day. It was the first time Indigenous designers showcased at Australian Fashion Week, and it was a full house of all Indigenous talent.
It made me so proud. Absolutely beautifully done. I mean, the designers, the pieces on there, I think just about every model or every second model was like, oh, I want that, I want that. So each of my pieces, we have our signature prints, which are each tell a story and is definitely a contemporary way of experiencing Aboriginal culture. And then each of my pieces are named after, inspiring Aboriginal and Torres Strait Islander women. So when the customer buys something, they're learning about the story, they're learning about women. I would hope that it isn't tokenistic, and I would hope that it's not done to tick a box. And so, those things have to be, you have to be mindful about that. But I think it's incredible what's been achieved so far, but, there's always room for growth. I think the elevation of Aboriginal and Torres Strait Islander people in these spaces, it's long overdue, and it's a really powerful and incredible time, I think, and to be a part of that is really special.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kaylee Lyons in New York. Now, there's quite a lot going on, Matt, in terms of great stories. We're looking at space, we're looking at a number of things, we're looking at cars. Millennials actually, because of the pandemic, buying cars again. But there's one story that trumps everything, and that's jobs and OPEC Plus, maybe.
Yeah, no, I think you're right. Oil definitely drove markets yesterday, but jobs is likely to be the movement factor today, especially we looked at the volatility around the jobs report, and starting around 8:30 a.m. New York time, you really see it almost double. So 1.5 to twice the volatility you normally would see in rates in the U.S. markets. It can be pretty dangerous, especially when you have rates compressed like this, 144, right? As we hear more and more Fed speakers, Kaylee, talk about tapering and eventually raising rates.
Yeah. Yeah, and I guess the story today is that, also parts of the market is closing early because of the 4th of July. We have U.S. jobs, so it could be a bit volatile.
Yeah, volume could be light, which could mean volatility is actually a lot higher. As for what the picture looks like right now, we are in positive territory, at least in the European session. Granted, we are off session highs, but still we're up by about 0.25% on the stock 600. Here in the U.S., we're coming off a 6-day winning streak for the S&P 500, the longest since February, and of course ended yesterday at a record high. We could add to that today. Gonna depend on that print at 8:30 a.m. Eastern time. Right now, futures up about 0.5 point. Going nowhere in the Treasury market. As Matt said, we're looking at a 144 handle on the U.S. 10-year yield. And then, of course, we also have to pay attention to OPEC Plus. The lack of a deal at this point, that meeting, of course, getting delayed until later on today. The UAE holding things up ahead of that. Oil down about 0.2% on crude, but still above $75 a barrel. Of course, another story we've been following relates to the Delta variant. We did get some good news out of J&J overnight, saying its one-shot vaccine is effective at protecting against that variant. That stock is only up, though, about 0.4% in early hours. CureVac has had less positive results with its vaccine. It's down by about 3.4%. Another stock moving to the downside is Iterum Therapeutics. The FDA, reviewing one of its drugs to treat UTIs, said it found some not so good deficiencies. That stock is down about 29%. And then we've already been talking about it many times this hour, but Richard Branson is going into space on a Virgin Galactic test flight on July 11th. That has the stock up 27% before the bell, Matt.
Amazing. Amazing. All right. We have heard from a range of banks, by the way, over the last couple of days about fierce competition they're facing for talent. This week, Credit Suisse, Barclays, and JP Morgan, as well as Bank America, are all announcing higher salaries to retain staff. Lazard CEO Peter Orszag told Bloomberg's Sonali Basak that flexible work is another important incentive.
What we have decided to do is be in the office Tuesday, Wednesday, Thursday, and work remotely on Mondays and Fridays. And that will be up and down, everyone from Ken Jacobs and me down to including analysts. We think this combination is the most attractive. You get the best of both worlds. We think this is great for people who are at Lazard and people who want to come to Lazard. So it's both a retention approach and a recruitment approach. There's a lot of competition for bankers right now.
Sonali Basak, Bloomberg Wall Street reporter, joins us now to talk more about That interview and really the hotted up competition in banking. People are getting paid more, and for the most part, they're also getting the choice to work from wherever they like, at least some of the time, right?
Yeah, absolutely. It depends on where you work, right? Because we see the biggest three investment banks taking a bit harder of a line on their staff, though also opening offices elsewhere for businesses more outside of investment banking. Some trading operations moving down to Florida, where a lot of staff is going. But we see a lot of banks also trying to provide more flexibility, right? Citigroup is still asking people to come back on a voluntary basis and trying to maintain that flexibility. Like Lazard, like Perella Weinberg, they think that 5 days is probably not going to be the norm, or there will be more flexibility baked in for even the most competitive of their investment bankers. So what is curious to me is which business model wins at the end. The hyper-aggressive, bring everybody in, win deals in a hot market type of strategy, or the strategy where flexibility brings you the best talent and therefore you climb to the top. We'll see how it works out.
Okay, so Wall Street is watching their work from home or not schedules. They're watching how much they're getting paid. They're also watching the IPO market because it's been a really hot week for IPOs. And then finally yesterday we got that S1 filing from Robinhood. What was your biggest takeaway?
The valuation that's estimated around $40 billion is more than 40 times their earnings last year. So, and that is with a host of legal challenges, right? That's punitive class action lawsuits by the dozens. That is that record FINRA fine. And so you see these retail traders, 20 to 35% of this IPO will, and that's pretty novel, right? You see.
Wait, their earnings last year was only $7 million. So it's way more than 40 times earnings.
Sorry, 40 times sales. My bad. Sales.
Okay. Yeah.
Thank you for that. But yes, rich, right? Very rich company. And so you've got to wonder. And by the way, a nice cash in for some of these early investors. Dan Sundheim was, star hedge fund manager, was a more recent investor in Robinhood. So people are Ribbit Capital, DST, NEA. So really big gains for not just the meme stock crowd, but the Wall Street crowd as well.
Shonali, thank you so much. Shonali Bazak there with the very latest on Wall Street and meme stocks and Robinhood. Now, joining us now is Barry Ritholtz. We've been waiting for this interview, Barry, almost all of our lives. Bloomberg opinion columnist and Ritholtz Wealth Management founder, because we finally figured out that you wake up early enough for us to call you very early. Barry, thank you for joining us. When you look at Robinhood and the meme stocks, does this actually kind of put fear in Wall Street bankers? Because we don't exactly know what this will become in 6, 7, 10 months from now.
So yes and no. I don't know if Robinhood is really going to frighten Wall Street bankers, but the innovator's dilemma is you must constantly be prepared for a faster, nimbler, quicker, cheaper competitor that can come and eat your lunch. I imagine Jamie Dimon isn't afraid of a lot of things. Cybersecurity is probably something high on his list, but the possibility of some upstart coming along and grabbing a chunk of their business has to be part of their strategic planning. So you always have to be aware of the next gen coming after you, but I'm not sure anyone really sees Robinhood as that threat.
What do you think, Barry, in terms of this, flexible working from home? Does it really, a lot of Wall Street trying to also pay some of their junior bankers a little bit more to make them loyal? Is it really all about competition and just paying your bankers enough to keep them where you want them?
So on the low end of the pay scale, it's all about wages, and they've lagged for a long time relative to things like profitability and productivity and inflation. On the higher end of the scale, it's really flexibility that matters. When Ritholtz Wealth Management launched in 2013, we set up virtually. We have staff, 40 employees all around the country now, and we've always been a virtual hybrid. Come into the office, don't come into the office, it doesn't matter, just do your job. So the pandemic work from home situation, we were built for by accident. And we found it to be a very effective tool for attracting and retaining talent. Now, it's a very different story with 40 people versus 4,000 people, but it's pretty clear white-collar professionals want flexibility to control their time, their family life, their, who's looking over their shoulder. And we've all learned over the past year, it's not unproductive to have people working from home. If anything, companies get more work out of people because
especially at a higher level. Right, Barry? Yeah. I mean, once you've gotten older, once you're tired of, being in the sort of inner office rat race at your cubicle, you want to be able to have a little bit more optionality. I wonder how it's going to hit the league tables, right? Right now, Goldman Sachs, JP Morgan, Morgan Stanley, they're all right at the top. But the question is, do you have to have your workers come in, your executives, your bankers come in every day to stay there? Or can a flexible work schedule, topple the big guys?
Think about what you just said about those league tables. If I'm a banker working 80 hours a week or 100 hours a week, and some 10 or 20 hours a week are me getting up, showering, shaving, putting on a suit, getting on a Uber or a train or whatever to get to the office, hey, if I could spend that time more productively, at least a couple of days a week, that's going to only add up to more business over time, or at least that's the argument being made for, hey, it's better for the company if you let your staff, they know what they need to do and they know the best way to do it. Give them the tools they need, trust them, and get the hell out of the way. Bigger banks tend not to love that sort of philosophy of letting employees figure out the best way to do their job.
So, by the way, Fran was right. When we were on a conference call for the show and somebody said, how come Tom gets Barry on surveillance? And our producer said, we can get him too. We were like, yes. For me, because I love talking cars with you, and we got these amazing car sales figures out yesterday, Barry. I mean, a gain of 40 or 51% for the month of June for U.S. car sales. Just unbelievable year over year. Obviously, people are buying more trucks than anything else. I don't know what that is, like the electric.
It's the Lightning, the Ford Lightning.
Exactly. But you know what I was thinking is, how are they going to keep up these gains if they don't have cars on dealer lots?
So first, let's put these are sales, not deliveries. So let's keep that in mind. Secondly, go back a year ago, Q2, Q3 of 2020, nobody was running to the car dealer in the midst of a pandemic to buy cars. So year-over-year basis, these are incredibly easy comparables. And so you're seeing a bit of a surge that's making up for lost ground. And you're also seeing a lot of people, I don't know about you, my expenses plummeted last year. And I started looking around at things, toys I wanted to buy, because I just wasn't spending the money I normally spent. And so there's a lot of cash in bank accounts.
So, Barry, car prices are going more up. My wages aren't necessarily going up. What do you think is the biggest headwind in the labor market right now?
So depends on where you're looking in the labor market. There's no doubt that there's a skill shortage on the technical side. Some of the things that were done by the last administration to reduce immigration has not helped our case with skilled STEM potential employees, science, technology, engineering, math, from places like Korea and China and Vietnam and all over Asia and parts of Eastern Europe. Those are enormous feeders into U.S. technology strength, be it Silicon Valley. The stat I saw is something like half of the C-suite is either first or second generation immigrants to the United States. So we're not helping ourselves by keeping those folks out. And then it's been pretty clear how long wages have lagged at the bottom end of the scale. And I know it's only an anecdote, but I wrote about an ice cream shop in Pittsburgh. The Pittsburgh Gazette is who first reported this. And they doubled their rate, their normal hourly wage from minimum wage of $7.25 up to 15. And instead of getting 2 or 3 applicants, they got 1,000. So it's pretty clear wages are driving everything at the bottom of the scale move up, and it's all about flexibility, the ability to take care of your kids from home and to control your own time.
I think the success of this show should help you boost your wages, Kaylee.
One would hope.
You're doing
I
it.
should take
You're
it
putting
up
in
with
the work,
management.
you know? Yeah.
All right, we'll have plenty more on wage growth, especially on this show. Barry Ritholtz there, Bloomberg opinion columnist and Ritholtz Wealth Management founder. Now, coming up, it's Jobs Day in the U.S. What to expect from the June employment report next. Well, more on that next, I should say. This is Bloomberg.
Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines in New York with Francine Lacqua in London and Matt Miller in Berlin. Well, we have less than 3 hours to go. The jobs report is out at 8:30 a.m. New York time. Economists surveyed by Bloomberg see a strong payrolls gain following 2 disappointing months of hiring. Michael McKee, Bloomberg International Economics and Policy Correspondent, joins us now. Mike, what the past couple of months have shown us is it is incredibly hard to forecast in this environment. But is it really the headline number we care about, or more so wages and the participation rate?
Interesting question. This is going to be, and I think Kit Jukes of SocGen put it best, this is going to give us a view of the economy that may be more an abstract painting to try to make something out of it. Obviously, if we have a disappointing number and the last 2 months have come in lower than the forecast, that's going to have an effect on the idea that the Fed is pushing forward of substantial further progress. The labor market is the one area that has sort of lagged in that promise of the Fed's. So we do care about the top line number to a certain extent. Now, the other number that we're going to care about is the labor force participation rate, because the Fed wants to see more people coming into the labor force looking for jobs. Barry Ritholtz was just talking about, the ice cream shop that drew a lot of applicants. If that's happening, if people are coming back, even if unemployment doesn't decline, they'll feel better about it because we know there's a lot of job openings and those will eventually get filled. I wouldn't worry about wages too much. There's still a composition effect there. The fact that the lower end got laid off and is coming back to work drags down a little bit on the overall average, but the average is supposed to go up significantly.
So, Michael, good morning from London, first of all, but what can you tell us about, the season? So are there going to be a lot of seasonal workers because we're July 2nd?
Yeah, this is always a problem with the June report, and it's going to be a little bit odd because the seasonals would have expected people to be hired in leisure and hospitality at a higher rate, and since they're being hired at an even higher rate right now because they're returning to work, that'll push down on the seasonally adjusted total number. Meanwhile, you expect people in the local education to be laid off, not just teachers, but bus drivers and cafeteria workers. And since many of them didn't work because schools were virtual here, then the seasonals may push that up. So this is going to be one of those reports where you're going to have to dig into it and look at it with a lot of caveats.
Michael, thank you so much. Michael McKee there, a Bloomberg International Economics and Policy correspondent. Of course, he'll be all over that jobs report. Now, coming up for the Biden administration's view on the U.S. jobs report, we'll also be speaking to the U.S. Labor Secretary, Marty Walsh. That's at 9:30 a.m. in New York, 2:30 p.m. in London, and this is Bloomberg.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacqua in London and Kaylee Lines in New York. Now, Loretta Perfectus Walsh became the first female sworn in as a U.S. Navy Chief Petty Officer in 1917. The USS Constitution, the world's oldest commissioned warship afloat, recently named one of its cannons in her honor. Bloomberg's Janet Wu explores the ship and speaks with its current chief petty officer about naming the gun and the significance of Walsh's service for today's female naval leaders.
The USS Constitution, also known as Old Ironsides, is the world's oldest commissioned warship afloat.
We try to have our sailors that give the tours and talk about her, like really bring that history to life.
It earned its nickname during the War of 1812, when British cannonballs were seen bouncing off its wooden hull.
You don't get to get fully immersed until you're here and until you see all of these guns on our gun deck.
One of those 24-pound guns has a new name.
I was walking the gun deck one day and I noticed that not all of them were named. Back in 1812, when they had gun teams, they rallied behind something. It was like a mascot.
The cannons also needed names because most sailors back then could not read. No records have survived for the original gun names on the USS Constitution. Some have names based on records from her sister ships.
Ours, we didn't have that history for the Constitution, so we pulled a little bit here and there, and we've actually gotten to name a few ourselves. And my idea was to name it Perfectus, after Loretta Perfectus Walsh, in honor of women in the military, in the Navy, and in honor of Chief Petty Officers.
Walsh was sworn in as the Navy's first female Chief Petty Officer on March 21st, 1917.
She was the first female to enlist in any branch of service, and she was the first one to get equal pay and equal rights and equal benefits, which was unheard of in like 1917. Her history is what made my history possible.
The naming ceremony, which also coincided with Women's History Month, was streamed on Facebook ahead of the ship's reopening to the public.
People are allowed to come on board, they'll get tours, they'll meet our sailors, and then they should visit the museum as well.
The museum exists to share the stories of Old Ironsides, to spark excitement about maritime heritage, naval service, and the American experience. We are so excited that Constitution has more female leaders than she's had in her history, and they have banded together and named a gun in the honor of an early U.S. Navy sailor.
These cannons are century-old replicas of the originals, and the newly named Perfectus is one of only 2 named by the current crew.
This is my dream job. Having the chance to even step foot aboard and be assigned to this crew is amazing, and I'm so lucky every single day. I want them to realize how far we've come as a military, not just the Navy, but as a military in general, and how much women have strived to overcome obstacles and challenges. Our history in the Navy has grown, and she's kind of grown with us.
All right, that is pretty cool. I mean, Boston is totally cool. I know we have a ton of viewers in New York, so maybe it's an unpopular opinion, but Boston absolutely rules, and I love to go there, especially for the 4th of July. It's really all about the music. The Boston Symphony Orchestra and Keith Lockhart are great musicians and great Americans, and that's really what makes this show so spectacular. Highly recommend the Boston Pops. We are streaming it live this Sunday on Bloomberg Television, radio, and on the Bloomberg Terminal. This is Bloomberg.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
I think consumers have money in their pocket, and we're going to have a super holiday season.
I do think we're far enough along that a lot of that scarring should begin to dissipate.
Even if the economy slows, rates stay low, inflation's going to moderate, and we're still going to get positive long-term equity returns.
We think any pullbacks or any pauses in the market could be short-lived and shallow.
Clearly, we're heading towards an environment where they have to consider tapering.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It's Payrolls Friday from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Friday morning, equity futures up 2 points on the S&P, 3112 after 6 straight days of gains on the S&P 500. Tom, your estimate this morning, 720K.
Lots of the series on the terminal are grinding in whatever direction, John. Grinding flatter yields, grinding this, grinding that. And yes, equity markets grinding up as well.
Yields lower, Tom, down a basis point or two. 144 on 10s going into this. That curve now sub 120. 2s, 10s, 118.
First thing I looked at this morning, a 118.475 on the 2s, 10s spread. And with it, John, look at DXY. I mean, this is the major dollar index. Bloomberg dollar index, BBDXY, has caught up in the last 2 days. Stronger dollar.
Showing a bit of strength. Euro dollar down to 118.21. Here's the quote for me from the last 24 hours. It's on the labor market in America, and it came from the ISM, Lisa. Labor challenges across the entire value chain continue to be the major obstacle to increasing growth.
And the key question behind this is, how much does this have to do with enhanced unemployment benefits? How much does this have to do with the pandemic that continues to ravage certain areas? And how much does this have to do with childcare? Probably all of the above, but it's going to take time, John. And until we work out those kinks, these employment numbers are going to remain perhaps a little bit lower than people would like.
2 hours, 30 minutes away. Here's the price action going into that on the S&P 500. 6 days of gains coming into Friday. Can we make this 7? 43.13 on the S&P. We advance 0.06%. In the bond market, it catches your eye. Your 10-year now down to 144.24. And Tom pointed out the dollar strength. Lisa, dollar strength, euro dollar 118.22.
Reserve to hike rates, and that I think is what people are talking about, and the reason why the 10-year yield is as low as it is. At 8:30 a.m., we get a little bit of insight into the deliberations of the Federal Reserve, at least the data points they'll be considering. The U.S. payrolls number comes out, the June jobs report. This is one of 3 data points for the jobs market the Federal Reserve will be considering at their September meeting when they really decide whether or not to taper, or at least that's the expectation. The key thing that I'm looking for is momentum. How much momentum are you seeing beyond services, or is it just isolated to services? Do we get any kind of insight into how much the enhanced unemployment benefits have affected the willingness for some people to come back into the labor market? 10:15 a.m., look for the political spin. President Biden is speaking about the jobs report. Expect him to talk about the bigger unemployment benefits. Expect him to talk about the need for more infrastructure and more spending, the disparity, the 2-tier, the K-shaped recovery. And today, I find this actually really fascinating. OPEC Plus is continuing to negotiate output cuts after yesterday's meeting ended, frankly, in somewhat of a debacle. I mean, frankly, the United Arab Emirates coming out and saying that they wanted to have a bigger say in how they measure the output. And basically, if they don't come to an agreement, then the current output levels would be rolled over, which are a lot lower than people say would be needed to meet demand. Right now, you are seeing Brent and crude traded on the NYMEX a little bit lower, but earlier in the day, it was higher. And the question is how much further the prices could climb if they fail to reach an agreement, John.
75 handle on both WTI and Brent. WTI 75.16, Brent crude 75.75. We know all about fuel. We know about oil. We know about travel. It gets expensive, Tom, over the long weekend. It would be really expensive, wouldn't it, to get a plane right now and fly to, say, Greece
It would be,
and take a long vacation.
Yeah, you know, and you've got to get quarantined for like 2 or 3 weeks. And,
Yeah.
you know, it's very difficult. And of course, all that we do here within her celebrity is try to keep it private. So there's like 200
Thanks,
islands,
Tom.
or they can't even count the islands, John. And I've been advised by one of her entourage, it's not Crete.
It's not Crete.
It's not Crete.
We found out it's not Crete. Lisa
It's
is
not
going away.
Crete.
Lisa is going away this weekend and will be gone next
like
week.
within like 3 hours.
But it's
like,
not Crete.
You know, I don't even think she
Right,
stays
guys.
for the last
Can we
day.
confirm,
Thank
Lisa,
you.
it's not Crete?
It's not Crete.
It's
Thank you
not
so
Crete.
much for
Okay,
maintaining
thank
my
you.
privacy. We really appreciate that.
No, anytime. That's what we're here for.
Thanks.
Randy Krosner joins us now, University of Chicago Booth School Professor of Economics. Professor, good to catch up. Randy, 8:30 Eastern, 2 hours and about 25 minutes away. We'll get the payrolls report. What are you focused on?
I really want to look at the sectors, and I want to look at the labor force participation, and then also look at what's happening to wages. I think all three of those are going to tell us important pieces of what's going on in the labor market, and all three of those are going to feed into the Fed's thinking.
Professor Krosner, we're enjoying here the idea that one of our talents is going away to Greece to enjoy a sun-swept 7 days. And I want to get the lesson from you of the human condition. Greece was flat on its back, and nobody in Western economics has recovered like Greece. When we recover from this pandemic, do we underestimate the human condition just to recover here, where unemployment will go down to 3%, that we will see sustained GDP? Do we just underestimate the human oomph of coming out of a pandemic?
Well, I think psychology plays an enormous role in these things. I think I was less of a behavioral economist before I went to the Fed, but then during the global financial crisis, I became much more of a behavioral economist. My colleague Richard Thaler will really.
I was going to say, I'm going to cut in here, John. I know you want to pick this up. Thaler's rolling over now. Thaler's watching the Cubs go down in flames, and he's got Krosner badmouthing, Gary Becker's entire legacy, and that's outrageous, Krosner.
Wait a minute, I didn't badmouth it. I just said I'd become more of a behavioral economist. I didn't badmouth anyone.
John, pick it up here. I mean, Krosner's got me totally rattled going after the legacy of the great Gary
Well, I think we
Becker.
should let Lisa do some work, Tom, before she goes away.
That's true.
That's so
We should.
kind of you.
Did
Thank
you
you.
see my tie today? For those of you on radio, I wore a lovely blue tie in honor of Greece.
Yeah,
for
the Greece
Lisa.
mention earlier, Tom, really tied in nicely to the U.S. jobs
Thank
report.
you.
It wasn't gratuitous in any way. Professor Krosner, please save us and talk a little bit about the idea of transitory and the idea of good inflation and bad inflation. We're getting a sense that possibly oil prices could remain as high as they are, even head toward $100 a barrel. We're looking at food prices spiking higher to the highest levels by some measures since 2011 due to the drought out west in the United States. At what point does this become a disinflationary force? How much does this sort of factor into the Fed, even though this isn't part of the core PCE?
Sure, I think they're looking at what are exactly you said, what are transitory factors, what are long-term factors, and also the concern is, could enough transitory factors lead to a long-term change? And that would be through a change in inflation expectations. If you remember, people have been getting low wage increases and facing low prices for quite some time. That's now changing over the last few months, where we're seeing a significant spike up in consumer prices on a whole variety of things. And we also see much more pressure in the labor market, where we're seeing not only bonuses being offered for people even applying for jobs, but does that turn into, just rather than a one-off bonus, to higher wages? And then if firms say, oh, well, our costs have gone up, we can now charge more, people are willing to accept higher prices. And then individual workers say, well, I want more wages, and the labor market's so strong I can demand more, or I'm going to go elsewhere. We see a very high number of people who are quitting their jobs. We only see that when people feel very confident about the job market, and this gets back to the human condition, where people are that psychology, that feeling of confidence is something that is very, very important, affects the labor market, and could affect the inflation process going forward. And that's one of the key things that the Fed has to look at They want people to have confidence, but they don't want people to think, oh, well, that means that prices are going to start to rise in a consistent way, and that the Fed is just going to support that and lead to much higher inflation than they would like.
Randy, have you got any insight on the metric that's guiding this Federal Reserve right now? They talk about substantial further progress, then they won't tell you what it actually is. And I think each and every policymaker right now has their own view on that. Is it the employment to population ratio? We've heard that mentioned many times. Is it the participation rate? What is it for you?
So I think when you ask them, you are going to get different views. And I think there isn't any like one magic bullet. I think the employment ratio, the number of people employed relative to population, is something that is important. And we see that going down because a lot of people have retired. No surprise during a pandemic and when there's a lot of uncertainty about the effectiveness of vaccines and concerns about health, that older people will say, it's just not worth it. I'm going to retire early rather than stay in the market. That's going to put more pressure on wages as the job market and the economy comes back, and there aren't as many people in that labor pool. So I think that would be a very important metric, and then also looking at the just what's happening to wages.
Professor, good to catch up. Good to see you, especially on Payrolls Friday. Randy Krosner there, University of Chicago Booth.
Thank you.
School of Professor of Economics out of London. Your estimate today, 720,000. Your low, 400K. Your high, 1050. Mr. Shepherdson over at Pantheon Economics, Tom. Pretty bullish on this one.
Well, bullish. There's some tendency upward as well. I don't have a strong feeling on John. And one of the things that would be interesting is if it's a yawn, if it's, if it just sort of comes in and we move on, because I think just as important is the month-to-month-to-month sequence. First thing I'm going to do with the revisions is calculate the 3-month moving average.
First thing I'll do, Tom, is look at how the market responds to it. We talk about that quite often. There is information in the data. There's a lot of information in how a market responds to the data. And yesterday we had this strange ISM. It had this really strong inflationary impulse to it, Lisa. And we ended the day with a curve flatter and yields at the long end lower.
The idea here is that the pressure would be short term. The more you have those sort of input costs going up, the harder it will be to get sustained inflation. That's not where inflation has to come from. As people say, it's from the wages side. And frankly, if people are having their buying power crimped, that's going to slow growth and slow inflation over the long term. That's why it's so important to keep parsing out where exactly the job growth is and where exactly salaries are increasing.
She will be here all morning, and she is not going to creep. Tom, every time we say that Lisa's not going to creep, people are going to start thinking that Lisa's going to creep.
They are. The way
she's not going to creep.
The way I look at it is we need to compare and contrast here. We're talking to Governor Krosner of the recovery of Greece. And John, I was surprised still the Greek unemployment rate 17.3%. On a labor basis, it's still the basket child of Europe.
Some of those European countries, those labor markets are still pretty depressing.
I mean, they probably, the way I look at it is Actaeon Taverna, which is on one of the islands. I mean, they've been around for 90 years.
Yeah.
And if you were to have lunch at Actaeon Taverna on one of the islands in
Which
Greece,
island, Tom?
I don't know. You'd probably get marinated anchovies and boost the employment.
Yeah, thank you. Thank you for that.
Lisa's doing her bit for Southern Europe,
exactly,
but not in Crete. 43.13 on the S&P on this Payrolls Friday. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The OPEC Plus alliance has fallen into bitter infighting. A key member, the United Arab Emirates, blocked a deal at the last minute. That forced the cartel and its allies to postpone their meeting until today. And it is casting doubt on whether there will be an agreement on production that could ease a surge in oil prices. Now, economists surveyed by Bloomberg forecast that U.S. payrolls rose by 720,000 in June, but recent forecasts have been much higher than that actual number. A variety of issues are probably keeping people from returning to the workforce, including enhanced unemployment benefits, childcare responsibilities, and health concerns. The jobs report is out at 8:30 a.m. New York time. U.S. forces have left Bagram airfield in Afghanistan after almost 2 decades. Bagram was the epicenter of the war on the Taliban and al-Qaeda in the aftermath of the 9/11 attacks. Afghan forces will now run the airfield. President Biden promised that the last of as many as 3,500 American troops would leave Afghanistan by September the 11th. After 5 years of tension over Brexit, British Prime Minister Boris Johnson is laying on the charm for Angela Merkel's last visit to the UK as German Chancellor. Today, Merkel will visit Johnson at his country retreat and the Queen at Windsor Castle. I'm Leanne Gerrans. This is Bloomberg. Stay tuned.